Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holders' commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.
Good morning, everyone. Thank you so much for joining. Welcome to CFA Society Nigeria's CFA Level 2 Revision Bootcamp. First, I want to say a big thank you to all our faculty advisors for giving their time, preparing their slides, and just taking us through this revision so that we feel very prepared in order to sit for our exams. Our first class today is quantitative methods, which will be taken by Olatoyin Boyo, CFA. The next class will be ethical and professional standards by Adiola Gbadebo, CFA. And then the last class by 3 to 4 p.m. will be derivatives, and that will be taken by Fola Abimbola, CFA. The presentation slides will be shared after the classes. And then we also stream live to YouTube, and the playlist is curated. A link will also be sent in our follow-up housekeeping email. Before we begin, just a couple housekeeping rules. Depending on how the facilitators would go, they'll definitely ask questions or share polls, whatever. Please feel free to participate. We'll be in the chat too, making sure that your questions are answered, and we're here to support in whatever way you need. We're a little ahead of time, but I think it's all for the better. So I'm just going to hand over to our facilitator for today. Thank you.
Okay. Thank you very much. Good morning, everybody. Can I get a thumbs up if you can hear me loud and clear, please? Please, can I get a thumbs up if you can hear me? Okay, thank you very much. So my name is Oluwatoyin. We're starting 2 minutes ahead of time. As already said, I'll be taking you through quants. I just want to have an idea of where we are in terms of preparation, in terms of quants. In a scale of 1 to 5, 3 being halfway there, can you tell me if you're almost ready for quants, which would be like a 4, or if you still have plan to do it towards the end of the exam time, which would be 1 or 2? Can I get those numbers in, please, so I have an idea of how much to drill into? Okay, so I'm not getting any feedback. The request is on a scale of 1 to 5. How prepared do you think you are for quants? 1 being I just started, 5 being I can take the exam tomorrow. A 3. Okay. Okay, so thank you, Enobong and Mohammed. So we'll start on cue. Just to repeat, my name is Oluwatoyin. The reason why I'm doing this is I want you to pass. It's my genuine desire for you to pass level 2 and 3 first time you write it, and so that we can all benefit from having the CFA designation. So I'll jump right into it. I'll be monitoring the chat, so if there are any questions or comments, please reach out to me. So we'll start with multiple regression. And what is it? So you'll see the slide. Let me just give you the gist, since I'm seeing 3s on the call. So multiple regression is 3 different things. Is that you want to identify if there's a relationship between a variable and a set of other markers, or you want to explain something or you want to do a forecast. So some people who trade in Forex, for example, will say, what will it be like? Is the Naira going to continue tanking or is there going to be an appreciation? That will give you an idea of what positions to take. So that will be a reason why you will do multiple regression. So multiple regression is different from linear because in multiple regression, there are different aspects to it. So we're not looking at a one-to-one relationship. We're looking at, let's say, like I had used the example of the price of naira to dollar exchange rates, and there are various reasons or various things will affect the relationship between exchange rates. And so one could be if there's either an increase or decrease in interest rates, or if there's going to be a sudden announcement, or if there's a war going on somewhere, or something else happens. So those are different reasons that could affect exchange rates. So you want to find out, is there a relationship? Do all of these things matter? If Togo, for example, says they are opening up their borders to something, will that affect the exchange rate, the naira dollar exchange rate? If America says they're going to shorten their borders, is it going to have an effect on the exchange rate? So linear regression, multiple linear regression, it explains the variation in the dependent variable. In this case, the exchange rate, naira dollar exchange rate, to other terms, right? So the y will be what you're trying to, the target variable, and then the x's will be the different features that could either affect or not affect that main variable. So you could have, let me come up with a better example. Is it going to rain tomorrow? Okay, that's a yes or no. So let me come up with a different example. That guy I've been asking for money, is he going to give me money on Monday? I've been sending him messages all over the weekend. By Monday, is he going to credit my account? I'm not sure. What are the chances that he's going to? What would make him give me money? Is it because I've been greeting him every month end? Or is it because last time he came to my house, I said there was no food to eat and I looked sickly? So you need to find it as a relationship. So the dependent variable is what it is you're trying to explain. There's usually one dependent variable, and then the x's are the independent variables that should explain what it is you're trying to come up with. So the formula is y is equal to b0 plus b1x plus b2x. It depends on how many x's you have, and then you will repeat, you have different observations. So the slope, it's a partial slope, is different from the linear regression in this case because you would have to hold all the other x's constant and then vary just one. So for example, if we're looking at b0 plus b1 x1 plus b2 x2, and we're going to stop at that. And so it means if you want to see what does b2 mean, it means you're going to hold b1 constant and you only vary the x2. That will tell you, so we call it partial because everything is not moving at the same time. What is the impact of me calling the guy 3 times in one day in me getting that money? Will he give me the money? So this is not a very good example because this is a yes or no, right? I should be speaking to something that is more continuous in terms of variability. Maybe if you're going to give me, how much beer will I get? If I go for a rave, how much beer will they pour into my cup? Will they give me half cup or a full cup? So that's more what I should be speaking to. So it depends on how many people are at the rave, if the bartender likes me, if he knows me, if he's just a generous guy or he's a very stingy person. So he might decide to give everybody a half cup of beer when they come up. When it comes to my turn, he might decide to give me a full cup because he knows me or because we hang out together or he just likes me. So that's a better example. So what are the reasons why he wants to give me a full cup? Probably because um, he's kind, or because I will tip him afterwards, or he sees that I'm with a pretty girl and maybe he wants to say hello later, those kind of things. So the intercept is when everything else, all the x's are zero, then y is equal to the intercept, the b0. So x will be zero, all the x's are zero, y is equal to a constant. So I had explained earlier, we use it to explain relationships between financial variables. We use it to test existing theories, or we use it to make forecasts. Assumptions, one of them is linearity. There's a relationship between the dependent variable and the independent variable, and it's always linear. The second one is homoscedasticity. That's the variance of the regression of the errors is constant. So let me explain what errors are. Because we're discussing potential predictions, it means that it will not always be exact as in one-to-one. If I say it's going to be 5.714, for example, that's the forecast, it might end up being 6 or it might be 4.3. So the variation between what I forecasted it to be and what the actual value is, that's what we call an error term. And so what we're saying is over time, the variation should be the same. The variance of those error terms should be the same. So this was point one, speaking to it being linear. So you can see that it kind of follows a straight line, and both the observations are on both sides nicely. This second option shows that there's a curve of some kind. So there's a compounding of some sort or an exponential growth of some sort. So when we speak to homoscedasticity, that's this portion, you see that this line now, the input varies on both sides, kind of nicely even above and below. There's no cluster of any points. And then when the variance is not constant, you see this portion on the left, on the right hand side, that the data seems to be very close to the red line, and then with time it's increasing in size. So that means it's dispersing more and more, and then it's getting bigger. So it means that for at time zero, it's very close to the mean, and then with time it's varying. So this tells you that the variance is not constant for the error terms. So another assumption of multiple regression is the independence of errors. That means they should not be correlated across observations. It means the error from before, like I said, was a 4 or a 6. I should not be able to use that to predict the error in the next term. Normality is that they're normally distributed and the variables are independent of each other. It means there's no correlation between the different x's. So we're going to go right into asking questions. So we want to find out the kind of regression model you use for, you have the question on the right, you have a data set, yt is equal to 0.9 plus 1.8 plus 0.4 plus 0.3, and you're asked to create a model to fit. Question one, what type of model, regression model will you use? A, B, or C? Can I get your potential answers, please? C. Okay, so I have two C's. Oh, everybody says it's C. So number two, I would prefer if you say number one, C, number two, so that we can track. So number two, determine which of the following statements about the coefficients of the volatility factor, that's the VIX, is true. A, B, or C for number two. Any answers to number two? 2C. Okay, so let's see. Drum roll. So we're on point. Looks like those people that said there were threes are more fours and fives at this point. So since everybody got the answer, I will not spend time explaining. It means we're okay with this. So let's try our hands on some other questions. Same question of returns on y is minus 0.9 plus 1.8. 3 is identify the regression assumption that will be violated. Oh, I don't have that chart. Okay, so let's move to number 4 and 5. I don't have those charts. Okay, so let's move on to, let's continue. So if we're discussing linear regression, right, we'll be discussing the coefficient of determination, R squared, which is how much of the variables are determined cause the variation in the dependent variable. In other words, how effective are independent variables, basically. How much do they explain what's actually going on? Because you know there'll be some noise. I had already explained that you have some error terms. So how do we minimize the errors so that the model is a very good fit? Means it closely tracks what's happening actual. That's what usual R squared is for linear regression. But we're discussing multiple regression, and so we have more than one variable, independent variable. And so we have an adjusted R squared. Reason is you don't want to say, okay, if I add a 2 or if I add a 3 and a fourth variable and a fifth variable, it will make the model better. Yeah, it might, but at a point, is either they start having correlation among themselves, or you're just overcomplicating things, and it will be too complicated, really. So you want to know what's that ideal? How do I balance off? How many variables do I want to include? And are they effective enough? So that's where the adjusted R squared comes in. It helps to overcome the problem of overfitting by adding extra variables. How many more do I need to add before I'm overdoing it? Some people say they like to work out, and are you spending all your time in the gym as against doing anything else is the question. So how do I balance that? Or someone says I want to lose weight, and so I'm going to go on a hunger strike for 3 days. You don't want to have an ulcer, you don't want to fall down, and it's together you have low sugar. So what's that trade-off of I want to eat, I want to lose weight? That's what we're discussing here in terms of adjusted R squared. So one thing to note is that the regular coefficient of determination R squared would usually be higher than the adjusted R squared. And so there's a trade-off of if the t statistic is above, is positive or negative, then the adjusted R squared will either increase or decrease. So I also mentioned the AIC and the BIC. There are tests to see how well our models fit. So we're going to discuss overfitting later on, but just as a warm-up, overfitting is, think of it like you go to the tailor and you either an owambe or a suit and you want it snug, you want it fitted, and he gives it to you. You wear it for the occasion, you're looking dapper. 2 months time, you need to wear it again and you realize you put on some weight. Now you have a problem, right? So overfitting is I want a model that will not only just work for the data I have, but when I bring data in future, or when I come back with more options, it will still adjust and give me what I know. So it's not so fixated on where I am now. It can vary with where I'm supposed to be. So overfitting is you have a data set and you don't want it to be too so correct that it cannot forecast into the future, basically. So AIC and BIC will help you check how well your model is. And so the lower the better for both of them. And then we take note that when you're talking about forecasting, AIC is a better marker. When you're talking about goodness of fit, BIC is a better marker. So if I want to know what will things be like in future, in maybe in 2 days time or in a month's time, I will use AIC to measure if that model is a good fit. If I want to see how well the model is tracking actual, how well did it model the data, then BIC is the way to go. So we have the F statistic. Because I'm talking to level 2 students, we would already be conversant with that from quant in level 1. And so this portion, just I think this works for me personally because it's easy. It's a bit difficult when you want to remember what the formula is and which is which over what and what goes where. But if you have this in your head, it's easier. So you see the regression, residual, and total, the degrees of freedom are clearly there. And then you see this one is sum of squares regression, sum of squares errors, and then sum of squares total, and the mean sum of squares, and then F. So this is an easy way to keep track of where we are. So we have restricted and unrestricted models. I think I have that on another slide. Okay. So restricted and unrestricted model is everything. Give it to me as it is. So you meet someone for the first time and the person says, I don't like to cook. I take my time in the mornings. As in you let it all hang out. That's the unrestricted model. So if you look to this portion, an unrestricted model in this case has 5 independent variables. So a restricted model is you say, because it's the first time, I don't want you to know that I love sleep. And I don't want you to know that I don't like eating pepper. So I'll just put my best foot forward. That's what the restricted model is in this case. So we've dropped variables x4 and x5, and we want to test if we do away with x4, x5, will he still love me? Will he still want a second date? So that's what unrestricted and restricted models are. So you restrict it means you drop some variables and you see without these variables, are we still good to go? Is the model still a good enough fit for the data set? Or do I need those X4s and X5s back? That's what that speaks to. So we're going to have, I would have asked that you I don't know if you have your materials handy, because this was a lot to fit into the slide. If you do, I will just pause for 1 minute and ask if you could get it out so that we can look at page 47, the practice questions at the end of that. Can I get a thumbs up if anyone has their materials handy? Anyone have the materials handy? If not, we'll do a toggle back and forth on the slides. Okay, so while I wait for that, we have 3 models: market, the volatility, and then we have model 2, there's an extra one, and then model 3 has a 5th one. So we have 3 different models. And so this is from the textbook. We have the ANOVA table, the analysis of variance table for models 1, 2, and 3. I'm still waiting to see if anyone has the books ready, or I will just have to talk back and forth. So we're going to answer some questions. One, is it visible or is it too small?
We can see it.
Okay, all right, yeah. So thank you, Mary. Okay, so question 1, determine which one of the following reasons, what's the reason for the change in the adjusted R squared from model 2 to model 3? Which one is most likely correct? So let me go back to model 2 and model 3. We're looking at the adjusted R squared. This is model 2. This is model 2. This is adjusted R squared for model 2 right here, 0.846. Model 3, this is adjusted R squared, 0.844. 8.44 versus 8.46. So we see there's a slight dip between model 2 and 3. And so the question is, what's the reason for the change? A, any other answers? Okay, I already said it was decreasing, so I've already narrowed your options. So your options are either A or C at this point. I have 3 A's. Okay, so just hold that thought. Let me note it. 2, 1A. So number 2, identify the model that provides the best fit between 1, 2, and 3. So just get ready for number 2. Between 1, 2, and 3. So let me give you, which one do you think provides the best fit? A, B, or C? Number 2. 2, that's a B. Any other answers for B? Okay, so we're consistent with B. Okay, so let's check what number 3 is. Identify the model that should be used for prediction purposes. What do we use for prediction purposes between 1, 2, and 3? Number 3, C. 3B, lowest AIC. Okay. Okay,
Hello,
so
can you shift it or we are only seeing model 1 on the system?
oh, I'm sorry.
No,
Is it better?
I think it's the your cursor is probably on the action bar. So move it up so that it can disappear. I think it's on the Zoom.
Okay, so is it clear now?
Yeah, it's clear from my end.
Okay, thank you. All right, so let's take that again. Thank you for that. Okay, so number 3, lowest AIC for prediction. Lowest AIC. Okay, so let's check what number 4 is. You're going to calculate the predicted return for model 3, given the assumptions that The market is 3. HML is -2. So these are the coefficients of the variables. I don't know if you have your books, if it's something you want to jot down quickly. Let me zoom in a bit. So market is 3. This is -2. This is -5. We have 1 and 3. If you could just take that down quickly so that we can go to model 3. So let's go to model 3. Or if you have your textbook, it will be a lot easier. So your A, B, or C. Can I get your answers for number 4, please?
Hi, sorry, please do you mind putting it back on the model table?
Okay.
Thank you.
Okay. So number 5, I didn't get any answers from number 4. Maybe it's toggling is a bit of a problem. So should we just go straight to the answers so that I don't lose anyone? Number 4A, okay. Answers are coming in. So number 4A. All right. 4C. So we have 2 different answers in number 4. We have an A and a C. So let's look to number 5. 5 says calculate the joint F statistic and determine whether the size to business and the month contribute to returns in model 3 at 1% significance level. So I just want to know, when we start discussing significant levels and t-testing and p-values, do I see people who get worried about it? Can I get a yes, it bothers me, no, I'm fine with it, so I know what to dwell on, please? When you see when we come to testing, is it an area of concern? Yes, it bothers me. Okay. Thank you, King David. It bothers 2 people. Okay. Is anyone? Okay, so that will dwell on that. Okay, so I have 1 person says I'm fine, 3 say no. All right. So do you want to attempt this, especially for Faith and David, who say it's a bit of a bother? How do you combine F statistic and calculate? Okay, so let's move on. So number 1, we had a lot of A's. 2, we had a lot of B's. 3, they said 1 with the least AIC. 4, I had an A and a C. So I would push off from 1, 2, and 3 and focus on number 4, if that's fine. So if I see a lot of people are getting the answers right, I won't spend time on that question so that we can focus on why you're here, which is to help you pass. Be mindful of time. Okay, so for number 4, let me zoom back into number 4. Calculate the return y from model 3 given these assumptions, right? So let me take you back to model 3. This is model 3. It has 1, 2, 3, 4, 5 variables, and let's focus on the answer. So if you said A, you were right. If you said C, I can't remember who said C. Faith said C. So Faith, if you pay attention at this point, so what we're doing is basically just substitution. You have this okay, let me go back. So this is model 3, right? And so this is where you have the B0, B market. This is where it is. These are the coefficients here. So the coefficient of the intercept is minus 0.823, 0.823. Yes, the market is 1.719. So it means where you see B0, you replace it with minus 0.823. Where you see the market, B market, you replace it with 1.719. And so where you see the monthly figure, where you see BMOM, you replace with minus 0.607. So effectively, if you had done that, you would have rewritten this formula to be minus 0.823 plus 1.719 market I plus 0.4212, and that was what it will have looked like. So let's go back and see. And then they now give you figures for the other part you didn't know, the x's that you were not aware of. And so that's what you see here. So it's basically substitution. This is a cheap point to get. I need to know if, Faith, can you tell me if you get it now?
Yes, I do. Thank you. I think I forgot
Okay.
to take out the intercept.
Okay, thank you. All right, so let's see what happened to number 5. 5 says there's a joint F statistic. So there's this formula. Let me go back and see if I had it. If it was, I had the later version before. Yes, so I have this portion. So, I had spoken to restricted and unrestricted. Unrestricted is let it all hang out. All the variables, bring it in, all are welcome. Restricted is, I don't like you're too short, you're too loud, I don't like the marks on your face, and so I'm going to exclude some people. That's restricted. So this is the formula you should have had in your head to calculate that. So they were asking us to compare two models. One had more variables than the other. And so this is the formula we were going to use. And so for those who struggle with test statistics, just know the decision rule in this case is to reject the null hypothesis if the F statistic that you calculate is greater than the critical value, which they would usually give you. So null hypothesis is usually that it's equal to 0, there's no relationship. And then if we fail to reject the null hypothesis, it means that those ones on the outside have significance. Let me take that again slowly. So H0 is usually, because you're adding more variables, like I said, I don't like he's too dark for me, he's too short. Should I marry a short guy? Should I date a short guy? I'm not sure. So is this significant in future? Will a short person matter in future is the question. So B4, B5 is equal to 0, usually beat null hypothesis, means it really doesn't matter. I can accept him. That means we should have the fuller version of the formula, x1, x2, x3, x4, x5. But if you say it's a big deal for you, then I don't want x4 and x5. I only want x1, 2, 3, right? So that's what we're saying here. And so we say you reject the null hypothesis that they're equal to 0, that those coefficients are equal to 0, means you want to include them in the model, and the model is a better fit because you have those ones. Can I see a thumbs up if you quite get what I just said? Okay. So it's 12:30 and I have an hour left. Looks like I'll need to move a little faster. Okay, so this was the question. And so this is the question. So we're looking at model 3. And model 3, if I remember, had everything. Yes, model 3 was the... So would you tell me, is model 3 restricted or unrestricted? Can you tell me if model 3 is restricted or unrestricted? Just write restricted or unrestricted for model 3. Unrestricted. Thank you. Because it has all the variables. All right. So I'm talking to people who understand. So let's move a little faster. So, all right. So this is the formula, the sum of squares of the restricted model. That is the, I think model 1 was unrestricted. It had only 3 variables versus the unrestricted, which has the 5 variables divided by the same, what you see here. What you see here is what you see here. These two are the same. And then you have the degrees of freedom. So it's just to know the formula and know what it's pointing to. And so when you calculate, when you break this down and substitute, you get F is equal to 8.8. At the critical value was 4.8. Your calculation was 8.8. And what we had said earlier was if what you calculate is greater than what is given, that's the critical value from the table, reject. So what we calculated is 8.8 is greater than 4.8, and so we reject the null hypothesis. The null hypothesis was this. See the null hypothesis, that they're equal to 0. So the conclusion is that they are significant. If something is not equal to 0, it means there's value and you want to add it. So I will need to move a little faster. I'll just crave your indulgence so that we can go through. We have so much to do. So we'll discuss misspecifications briefly. Does anybody want me to go back? Okay, let me keep going. So we'll discuss model misspecifications. So different things can happen. You don't include something that is absolutely critical, right? You're discussing maybe stock prices. How well does company A do over time? And you don't include maybe their PE ratio in your calculation. I mean, that's a no-brainer. You want to know what they're doing in terms of revenue to see is it a good idea or not. You know, so there are some things that are specific. You say, or you bring two things that are kind of alike. Like some people like chili when they eat, and so some people will say, I've already put pepper in the food when I was making it, and then someone comes and now takes maybe Cameroon pepper and sprinkles on top. So now you don't know whether the food is so pepperish because it was because of Cameroon pepper or because the person used red pepper when they were cooking. You know, all you know is that it's very, very hot, but you're not sure which is contributing. So where there's a relationship between the two kinds of pepper, you're not sure which one is actually making your head hurt at that point because the food you're eating is very chilly. So those are some reasons you don't want to pick two variables that are so closely related that you can't tell which is affecting me now. Am I drinking plenty of water because the food you made was already pepperish or because I added Cameroon pepper? So those are the kind of reasons for model misspecification. You need to be sure that you have very distinct unrelated variables and you can, at a point in time, pinpoint what is causing the variations in Y as well. So we have, I had spoken to the heteroscedasticity before now, where the error terms, the variance of the error terms are constant, means over time they are kind of equal. Let me go back. This is where it was, right? So this is it. It means it dances around the mean, kind of. It's not too bad. It's always either a little way away or a little bit close. Think of when you're walking your dog and it's on a leash. There's a distance your dog can't move away from. You would always be around within that range of the leash. That's what you know what I'm saying. So heteroscedasticity means the dog is not on a leash, and so he can wander, and then he'll come back, and then he'll wander away, and he'll come back. So we want the variance to be within a certain bracket. That's what we're speaking to here. Yeah. And so I had spoken to multi-collinearity when the independent variables, the x's, are correlated. Like I said, someone cooks and had already put a lot of pepper. You take the food and say, because I love pepper, you pour caramel pepper on top of it. Now we don't know whether it was the food, the person that cooked that put plenty pepper, or it was you that put plenty pepper. So when there's a relationship, in this case, both of them are very chili based, then we have a problem. We're not sure which is which. Serial correlation or autocorrelation is when the error terms are correlated across observations. So it means there's a relationship of some kind. Now we need to find out why. It means there's a problem with the model and we need to fix it. So a positive serial correlation obviously means if the last one was positive, the next one will be positive. Negative means if one was positive, the next one will be negative. So I don't think I'll spend time on outliers. Outliers simply mean you have a bunch of people, everybody in class is getting C's and B's, and then you have someone that gets an F. How? Or you see all of us getting B's and C's, and then those ones that used to read book a lot, someone gets an A. That A is an outlier. Those people will distort the average in the class. And then when you get home, your parents are asking, what were you doing when the class average was 84? You will know that it was two brainiacs that jacked up the class average and we got to 84. If you had removed those two people, if they were ill and they didn't come to school that day, class average will have been where we are, which is the B's and C's. Now they're taking it to the A range and your mom is asking you what happened. So that's what outliers are. And so they distort our class average as it were. We want to keep those people away from our models as much as possible because you'll be modeling assuming those people are normal and they are not. They are not. They read a lot of book. So dummy variables are either a 1 or a 0, either a yes or a no. Am I going or am I not going? Is it going to rain or is it not going to rain? The other continuous variable will be how much rain is going to fall. Is it going to fall, when rain falls, is it 2.143 or is it 5.76? But a dummy variable is yes, no. So we use, you can see that here, and then we use a log normal model when there's compounding, it's not linear. So I'll go to time series. Time series, do I spend time on time series or not? Can I get a thumbs up or no?
Might spend time on it.
Spend time, okay. All right, so let's talk time series. So time series, think time. Anything we're doing is against time. So you're checking how have I been doing? How well did I do last week? How am I doing now? What am I going to do tomorrow? So time is always the basis in time series. So there'll usually be a trend. Sometimes there's a trend. Sometimes there's a linear trend, which is similar to what we just discussed in the regression model. Sometimes you have a log linear trend where it means there's compounding. And so we have autocorrelation, which is if there's a correlation against the past values. So think in terms of one of the comedians hosted a show, and so he sold maybe 1,000 tickets. And the week after, someone else hosted a show and he sold 1,002. And the next person sold 1,001. You that you're coming and you're very think of it. If these people are in my league, how much do I think I'm going to sell? So it's tracking over time. Or in terms of sales, if you stocked up and you sold 5 yesterday and you sold 7 tomorrow, how much do I think I'm going to sell next tomorrow? So you're always moving from one step to the other. Where you're coming from has a great impact on where you're going. That's what time series is basically. And so for us to plot the data and for us to model the data, some things need to be in place. We call them conditions for stationarity. That's here. One is the mean should be constant over time. It means, like I said, the example of you have a dog on a leash. No matter where you go, the dog will always be around me. As long as that leash is in place, the dog cannot go past a certain point. And so over time, if you think back to those graphs where you see Naira tanking over time, you see that one, the mean is not constant because I don't know what Naira is today, but a few months ago or last year, it was maybe 950 And on the average, it will vary 950, 970 to come down to 940, 950. If you plot the mean for that week, you will maybe land at 950. And then at a point, it was 1007. So for those 14 days, if you were checking what the mean was over those 14 days, it would be 1007. Then I know it came down to 1006. So you see the mean has been shifting over time. So that is not that's not stationary data as a way. You need to cure it. I hope I didn't make anyone feel bad if anyone was betting against the dollar at that point. So same thing for variance. You want the variance to be relatively stable, constant over time. You don't want it to be either getting too wide or shrinking over time. And then there should be a constant and final covariance between values at any point. So when we discuss auto regressive, it means I'm saying, okay, let me stick to the math. So the formula is x is equal to b0 plus b1, x minus 1. So this is x t minus 1 is yesterday. Okay, if I'm doing daily data, for example, x t minus 1 is yesterday, t minus 2 is 2 days before, and then t minus 3 will be 3 days before. If I'm doing monthly data, x t minus 1 will be April, and then t minus 2 will be March. And if it's annualized, t minus 1 will be 2024, t minus 2 will be 2023. And so what we're saying is you have, sometimes you just want to see, I want to use the last data set I have to predict the next step. I just want to go one step back. I don't want to go too far back into history. Sometimes you say, I want to see the last two will be the most important for me. So what did I do yesterday and day before? Or what did I do in April and in March? That will form the basis for my forecast. And sometimes you say, I want to go 3 steps back. So that's what the AR model of order P stands for. P is how far back in time do you want to go? And you can obviously go all the way back to Genesis, the beginning, but you will realize that if you go all the way back to Genesis, you will not want to weigh whatever happened in Genesis as much as you will weigh what happened yesterday, because the expectation is you've been factoring in all the things that happened at Genesis, and now you will want to figure out what happened yesterday is most likely going to impact what's going to happen tomorrow more than what happened last week. You know, they say the good things you do to people is the last one they remember. I've been good to you all this while. The day I say no, that's when you remember. So that's what AR models are like. So do you want to just say because he said no yesterday, I couldn't pick you up yesterday, you now say the person's a bad person? Or you look at the track record to say over time you've been a very good friend and today you can't show up, means there must be a reason why. So if you are the kind of person that says every time I say I need your help, you must show up, it means you have an AR role model. I only look at yesterday. But if you're the nicer person who says over time you've been good to me and maybe you're having a bad day, then it means you want to incorporate more values. Maybe you have an AR4 or an AR5 model. So the problem with that, of course, is the more variables you have, the more complicated it gets. You might not know who is speaking to what, they might be related and stuff like that. So we use a t-test to see, should I just pick yesterday's value? Should I pick yesterday and day before? Or should I pick the last 3 days? And I'm here right now. We say time series it should be mean reverting. Mean reverting is if the mean is 5, for example, no matter where you go, you come back to 5. So if the mean is 5 and yesterday my value was 8, I shouldn't expect it to be going to 9. I expect it to be coming closer to 5, which is the mean. And so if you cross 5 and you go to 3, it means you should be tending back towards the mean, which is 5. So if the mean is 5 and you go up to 8, it means the next value in the model should be shrinking back to 5. So I'll expect a dip. And if I'm on 3 and the mean is 5, I expect it to be going up. So it's just like people who say, at the end of the day, you would come home, no matter where you go throughout the day, whether you go to work or you go to see a friend or you go to watch a movie, at the end of the day, you're expected to sleep at home. So take the mean as coming home at the end of every day. So whether you say, I'm not going anywhere today, I'm going to stay at home, that's fine. If you say, no, I want to do a good work, and so I'm going to exhaust myself, I'm going to be tired, I'll go to the gym, I need to replenish, you'll come back home. So no matter what you do, always remember that you want it to be mean reverting, you always want to come back home. And so what we're saying is at the end of the day, because you will always want them to, you always come back to the mean. The expectation is what happened yesterday should replicate itself today, should replicate itself tomorrow. And so for an R1, AR1 model, I had said, we're just looking one step back. And so it means that you should expect that what happened yesterday happens today. And so we can replace that t minus 1 with t. And then when you solve for xt, you have this formula, which means that the intercept over 1 minus the coefficient of x would, that's the formula here. And so we use it to predict whether the B1s are significant or not. So we discussed in-sample data, which is using data you already have, what you've observed over time, and you use that to model what can happen in future. So a random walk is when you're jaywalking, you're just moving all over the place, not reverting to any mean, you don't care about anything. You just pick a place to go and say, today I feel like eating Chinese, and the first Chinese restaurant I see, I'll stop there. And that's what you do. Tomorrow you say, I want seafood okra. The first seafood okra billboard I see, I stop there. And so that's basically what random walk is. So seasonality speaks to, you see a pattern over time, right? We know that it's rainy season right now. And so you should expect, if anyone was tracking the amount of rainfall at this time of the year, there should be a spike. Towards December, there should be a dip. So that's what basically seasonality is. If you are into sales, you should expect that times of holidays, the place is jam-packed. Everybody has time off work, and so they can be out, they can spend, things like that. So that's what seasonality is. At a particular time, there's a peak, and then we see a dip. So we've already said that you need to adjust for seasonality. We want our data to be clean as possible. We want it to be free of noise, basically. So all these patterns I'm saying, I generally don't want to see them. And so we'll have to use things like the app model to get rid of things like that. So I want to also touch on structural change, which is here. So structural change speaks to, you see the data trending and there's a sharp break and everything changes. Think COVID. There was a way we were living, there was a way people were, people who were selling masks at that point probably used to sell maybe 1,000 packs per month, and that was where they were. COVID happened and suddenly they were hot cake. So if you were tracking sales of masks, you would have been seeing 1,000, 1,005, 1,900, and you jump to 10,000, 15,000, and wondering what happened. So when you have that kind of break, when something shocks the system and there's a drastic change, then you will realize that you can't use the same model for pre-COVID and post-COVID. You will need to have two different models because what happened is something that shocks the system, and so pre and post will not be the same thing. So we'll go into some questions briefly. Alfred, I see you. I'll come back if I can. Let's go into some questions briefly. We have an area 1 model and it has been estimated as produced the following prediction. X is equal to 1.2 plus 0.4 xt minus 1. Calculate a two-step ahead forecast if the current value of x is 5. Two-step ahead. Would you want to try that? Can I see? Okay, so while we're on that, let's look at number 1. Which of the following is true of modeling a time series that contains two or more distinct periods where the data is fundamentally different? A, B, or C for number 1? 1C. Okay. 2. Which of the following indicates the presence of an arc in the time series data? A, B, or C? To B. 3. Linear regression is least appropriate for modeling the relationship between two time series when A, B, or C. Three B, 3C. Okay, so let's see. So we're going to spend a bit of time on this. So let's go to the blue portion. We want to estimate 2 steps ahead. So the formula is xt is equal to 1.2 plus 0.45 xt minus 1. So if x is 5, then substitution like we had done before, t plus 1 will be substitute 5 into this, which is what they did here. They got 3.45, and then 2 steps ahead, x t plus 2. So remember, like I said, do I remember what you did yesterday, or do I remember what you did over time? So in this case, they're saying, I'm here today. If it's a daily data, where will I be in 2 days' time? If it was weekly data, where will I be in 2 weeks? If it was monthly data, where May, June, July, where will I be in July? So we need to be conscious of that to know where we're starting from and how many steps forward or backward we need to integrate into. So 1 was 1C. Okay, so everybody got 1 as C. I won't spend time on that. 2B, I won't spend time on that. Everybody got 2B. 3 is where we'll dwell on a bit because I have a B and I have a C. So linear regression is least appropriate for modeling the relationship between two time series when neither series has a unit root, one has a unit root, the other does not. Both have a unit root, and the time series is co-integrated. So, someone Alfred had asked about a random walk. So, a random walk, like I said, is when you're jaywalking. Anywhere belly face. When I go out, any joint I see, I enter. Or if I need to get drugs from a pharmacy, I'm not particular on which pharmacy. Anyone I see, I will enter. That's basically what a random walk is. So when we discuss one having the unit root, it means that the coefficient is 1. And so that means it's non-stationary. It means we're walking anywhere we're going is fine. So that's basically the difference. So in this case, if only one time series has a unit root, we should not use the linear regression. If neither has a unit root, or we both have unit roots, and they're co-integrated, then we can use linear regression. So the answer is B. Let me see. Who was that? Faith said C. Faith, I hope you've gotten it. Alfred, you know unit root now because you got the answer right. So let's go to machine learning. I have 36 minutes left. So let's go to machine learning. So machine learning, where are we? Deep dive or we can skim through? Can I get feedback, please? Machine learning deep dive or deep dive? Okay. All right. Deep dive with an exclamation mark. Okay. Let's go there. So we're discussing machines, algorithms. Think using your calculator for something as against using Excel. That's what machine learning is. So machine learning, I said, think linear regression on steroids. So we're ramping up to the 100th power. That's what machine learning is, basically. So what we've been discussing, linear regression is the younger brother of multiple linear regression. And so now we're moving on to the bigger boys. That's basically what machine learning is. And so it performs, let me speak the right lingua, it performs better than statistical approaches. You use algorithms So imagine different reiterations. I tried the first time, I tried the second time, third, fourth, fifth, 100th, 1000th, and I just keep trying. And so based on how I query the data, I either see a pattern and I'm better. It's imagine you meet someone, you spend a week with somebody versus your brother or sister you grew up with. Now, when the person you've known for a week says something, you might not know whether the person is joking or not. But your brother, even with just an expression, you can tell whether he's okay or he's not, right? So that's what machine learning is. So you spend so much time in the data with so many varying algorithms that you're better able, your models are a better fit than if we're doing multiple regression. So that's what machine learning basically is. And so the lingo is a bit more sophisticated because I said we're dealing with the big boys now. So what we're calling dependent variable for y, we're calling target variable now. And so what we're calling X variables before, we call the features now. But it's basically the same thing. So just think of it. No need to overcomplicate. This deep dive is basically the same thing. It's just you know how you have some people that don't have money, but when they dress up, you think they have money. Kind of the same thing. No need to fear. So it can be continuous. So the variables can be continuous. Like I said, how much rain is going to fall, how much rain is going to fall, those kind of things. Your weight, sales, those they're continuous. It could be 5.1, it could be 3.4, it's not fixed. And then you have the categories, which you would say is either your male or female. This is where I am. You say you're male or female, you say you have colors green, white, yellow, and then it could be ordinal where you have low, medium, high. So the difference between continuous is clear. It's numeric, but it's not discrete. So it means it could be anywhere along the number line. It could be 5.4, it could be 4.3. Categorical and ordinal, in this case, they're distinct, right? You can differentiate the categories. The difference between these two is for ordinal, you have a clear distinction. It's either you agree or you don't agree. It's either is low or is medium. But for the categorical, it could be colors, it could be blue, it could be green, so there's a slight difference. So the training data set in machine learning is the sample you use to fit the model. So we want to know, should I buy into company A when I hammer in 2 months' time? Before you wait to the point where you hammer, go and start reviewing their financials and say, what have they been doing over time? And so that going back to review their financials over time before you hammer is the training data set. You're going back to what was obtainable and what you can see. And you're going to use that to predict, will they be a good idea by December or January? That's what training data set is. And so we have two types of machine learning. We have supervised learning, which is what I just spoke to. You go back in time and you have observable data and say, I'm going to use this to decide a go or no go. Unsupervised means you're not telling it to focus on company A. You just throw things up. Like someone says, check all the, if you live in, let me say Ikoyi, for example, or okay, let's say, assume you work in VI, and say, check the Twitter feed of everybody that is in VI, Monday to Friday, 7 o'clock to 4. I mean, some people are checking cards, some people are checking how to remodel their houses, some people are checking how do I break into my boyfriend's phone, all sorts of things. In fact, we don't even know where Belle is at this point. So that's what unsupervised learning is. We're not saying give me something in particular. We're just saying go through everything they've been doing and tell me if you can find a pattern. That's what unsupervised learning is. Supervised learning is when, like I said, I'm going to hammer, and so I have a goal. I want to invest in this company. I need to know which company to invest in. Let me see if we're on course so far. Can I get a thumbs up or no? Because this is the building blocks of everything we're going to do. Are we still together? Okay, so let's continue. So what's overfitting? We had spoken to, yeah, thank you, Kebe. So we had spoken to overfitting before. It's after fasting for Christians and Muslims. and you shed a bit of weight, or you want to fit into your wedding dress and you go to the tailor and say, measure me, and they measure you, and when you wear the dress, you're looking dapper. And then you now forget yourself and say, man, this life is one. And you go into town and you're eating and drinking and saying, we don't know what will happen tomorrow. Then you go back and wear the same dress and now it doesn't fit. That's what overfitting is. So this here, you have a line, is a straight line, but you have the data above and below the line, and you say, some people are perfectionists. No, this thing is not quite. I want to remodel so that it tracks better. And then you remodel and then you get this, and you're like, this makes more sense. You see the way it's going all over the place. It's genuinely tracking the data now. This is a better fit. Yeah, it could be, but at what cost? This is where I am. It could be, but at what cost? So you see, you had a simple y is equal to this plus this. Now you have a y is equal to x raised to the power 4, x raised to the power 3. And so for the people who are control freaks, they prefer the model on the right. The problem with the model on the right is very, very complex. And it will fit you, it will fit the model you have so much that when you throw in an out of sample data, the thing is confused. It doesn't know what to do with it. So when you now go and eat 3 amala and 5 ice cream, and you wear the dress saying, no, this was not the agreement. I don't know how you're going to zip up at this point. So that's what overfitting is. You don't want to be so meticulous on tracking every single thing that when you bring in out of sample data, the model doesn't know what to do with it. Right? That's what overfitting is in plain English. So we're going to ask some questions. I understand that your exam starts in 10 days to 2 weeks. So I hope that you're spending all your time solving questions at this point. So let's try. 1. Which of the following best describes machine learning? A, B, or C? Number 1. One B, okay. So 2, everybody says 1B, okay. 2, which of the following statements is most accurate? When attempting to discover groups of data without a target Y, as you don't have a specific you're targeting, what do you do? A, B, or C? Two A, okay. 3, which of the following statements concerning supervised learning best distinguishes it from unsupervised learning? Supervised learning involves A, B, or C? Number 3. 3A. Can I get one more response on number 3? We're consistent in our answers. 3A. Okay. So 4. Which of the following best describes dimension reduction? Okay, I didn't speak to that though. Well, let's see if number 4. Or C. Okay, another consistent answer. So let's see how we're doing. So 1B, 2A, 3A, 4C. Okay, so looks like we're all aligned so far. So I'll move on. No wrong answer, so no need to explain. So I've discussed overfitting extensively. I will not need to come back to that. So how well do we, to measure how well a model generalizes, you want to look at your training sample, which is what I said. Go back in time and say, how well has that company been doing to see how they're doing. Then you need a validation sample for tuning. So tuning is, if I have the model, I now test it. I take what I already know and say, how are we doing so far? Is it predicting properly? In sample predictions is within the data set you already have. Out of sample happens for what hasn't happened yet when you throw in fresh data. Like I said, if you throw in fresh data, does the model adjust and continue forecasting right? Or does the thing say, come, I don't know where you're coming from? So that's what it is. So biases are errors, obviously. And so what you want to do is, I have spoken to the trade-off of overcomplicating things versus being accurate. You need to strike that balance. Do I want to go on a hunger strike or realize I still have to go to work and I don't have a headache at work? So maybe I'll eat an apple instead of just not eating at all. You need to strike that balance. And so that's what all of this speaks to. So we're going to discuss supervised learning and support vector machines. And okay, so I have this here. We're still discussing when you have data that you're using. And so this is for the k nearest neighbor. So I've grouped my data already into maybe, okay, I said I want to hammer, right? In 2 months' time, I'm expecting an inflow. And so what do I do? So I've reviewed different financials and I've decided these ones, I don't think I want to invest in them. They are red. I plotted them on one side. And the ones I think will give me the highest returns, the least risk, are the greens. I put them on this side. Then something happens and I get fresh data. That's the blue. You know how they say bad company corrupts good morals. If I see your friends, I have an idea of whether you're a good person or not. That's what we're speaking to here. So if I say I want to say K is 5, I will look at the 5 closest based on what I had observed before, which is the reds and the greens, and say 2 reds, 3 greens is most likely a green, right? If I had said I wanted to do maybe K is equal to 10, then the 10 nearest data points and see whether you're getting more greens than reds. The problem with this is if I had only 2 greens, for example, and everything else was red, if I expand my data, my K is equal to maybe 15, for example, it means no matter how much I do it, I only have 2 greens and then I'll have so much reds. So I'll make a mistake in thinking it's a red. Meanwhile, it's not a red, it's just because the green, there were no plenty. I don't know if I need to take that again or you got that. So that's what KNN is. So you already decided either green or red, and then you have a fresh entrance and you're not sure how to categorize it, whether you should categorize it as a blue or a green. And so I skipped one, penalize them regression models. You want to like constrain the model to minimize the sum of squares errors. So you're going to come up with a variable, a coefficient, and so you're going to use that to force the model to behave itself. Just like how you're a size 14 and now you're a size 12 and your clothes feel they can be flowing everywhere when you want them to look snug. What you do is you take them and you have them take it in. So that's kind of what penalized regression is. You force the model to behave itself and stop hanging all over the place. So a lasso comes up with a value that sometimes will eliminate some of the coefficients completely, as in it shrinks it so much that sometimes it will even just take out one of the maybe B2 X2 or take out the B5 X5 completely. That's what that is. So it shrinks the error term as much as possible. So the CAT is used for both classification and regression. You want to see where do I place this target variable, 1, and how do I predict it? That's 2. The ensemble and random forest. I said think getting advanced from different friends and the internet and combining them to chart a way forward. So in this case, you have you go to one person, you go to a model and say throw out results, and it churns and it gives you results. Then you go to a slightly different model and say give me results, and it gives you a set of results again. And so you combine all the solutions from the different results, from the different models, I'm sorry, and then you say this is the best way forward. So that's what it is. So which was why I said you go to different people. Your friend says go like this. This one says don't go like that. and then you go to the internet and say, what's the internet saying? And then based on all the data you've gotten, you say, this is my best move. That's what ensemble and random forest is. Random forest is you take I picture a bag. Imagine a bag where you have stuff, and so you have different bags. You run through different scenarios, different algorithms, and at the end of the day, you try to come up with what you think is the best fit. Unsupervised, like I had spoken to, has to do with, I have 20 minutes left. Unsupervised has to do with, we're not sure where we're going. We just throw in the data and see what comes up. See if the system can find a pattern of some sort. And so I will speak to the neural networks, which is similar to what happens in your head where your neurons are firing. And so there's a link between them. So that's why we speak to nodes on this point. So you have the different points in your head. So this one is talking to this, talking to that. And so there's that mapping of coming back and forth. And so if we speak to the deep learning networks, so we have neural networks and there might be hidden layers. So there are other levels that you cannot see. You use things like this for, we're not discussing numbers now. We're discussing in terms of image recognition for patterns, for recognizing characters. So those are a lot more complex, and so they require a bit deeper dive. So, okay, so let's ask some questions. And so if after now, if we still have time, if there's any other portion you would like me to speak on, because I have as it is 18 minutes. So, one, image recognition problems are best suited for which category of machine learning? We have ABC, number one, 1C, 1. To be described as a black. Number two, two C, 2B. Number three, an analyst wants to categorize an investment universe of 1,000 stocks into 10 similar groups. The machine learning algorithm most suited for this task is A, B, or C. Three, A and B. Okay, so let's see how well we've done. So 1C, right? 2B, right? 3B. Okay, I had A or B. Okay, so let's discuss. So, one, image recognition problems are best suited for. I had just spoken, that was the last thing I said. Let me go back. That was the last thing I said about you having so many hidden layers, and so you're discussing images and patterns and character recognitions. So, for deep learning, two is which of the following is least likely to be described as a black box approach to machine learning? So, black box approach is when it's difficult to understand. It's you know how you have those magicians that you don't know what's happening. Next thing you see something coming from somewhere, wondering how did that happen. So that's basically what a black box approach is. And so classification trees are popular because they provide a visual explanation of the predictive process. And so random forests and PCAs, the principal component analysis, don't give clear guidance about the features. Number three, an analyst wants to categorize an investment universe of 1,000 stocks, which is most suited for this task. It's clustering. Because you don't have any specific labels, you want to use clustering. I think that's all I have. So we have 14 minutes to tell me what portions of what we've discussed so far. If not, I'll hand over to the CFA Institute and say thank you.
All right. It looks like we don't have any more questions from the attendees. Thank you so much, Oluwatoyin. Really appreciate your time and your wonderful examples during the course of this session. Thank you so much. So up next at 1:30 is Ethical and Professional Standard by Adiola Gbadebo. So we'll continue the class at 1:30. Thank you all for staying.
Hi, good afternoon, Ms. Adela. Could you please share your
Good
screen, your
afternoon.
slide?
Can you hear me?
Yes, we can hear you
Excellent. I didn't know the
just
other
fine. Can
section.
you test your slides to see if they are fine?
Yes, that's what I'm doing right now. So you should see that shortly. One moment. One moment. I'll be sharing shortly. Oh, the background was a little bit. Oh, sorry. Um, Apologies. I'm having a little issue showing the screen, sharing my screen. Just a moment. I think I just sent my slides to Sonia. I don't know if they can see, just in case they can help me. For some reason, I'm having issues with this.
That's fine. I've sent you a message on WhatsApp. You can send to my email, or I can just, yeah.
Okay, one moment. Okay, I've sent it to you. I hope you can share it. I'm still trying to share it. Let's see. I think I'm having issues with the Microsoft too, and unfortunately, my second device isn't powered up. One moment. Okay, let's see. This is showing. Apologies, everyone. Just some teaching issues.
No problem. Where you sent it to my mail? Okay, I've seen it. Which one do I open first?
So are you able to see my screen now?
Yes, ma'am, we
Yes,
can.
we can.
Okay, excellent. Apologies, everyone. I think we're good to go. So I guess I can start, right?
Yes, please.
All right. Good afternoon, everyone. I know it's been a long day for you already, so I'll just dive right in. And luckily, it's level 2 revision, so you're no strangers to CFA ethics. Uh, you've done the first one in your first level, so I know that it's not strange to you. So we'll get onto it. So I always like to start by reiterating why it's so important for us to pay attention to ethics. Sorry, you already know the weight. I think this is for level one. Level one weighs between uh 15 to 20%, but level two and level three is between 10 and 15%. So that's why it's really critical. And because it's consistent through levels one to three, whatever you read and learn at every level still helps you when you're doing any of the levels. And I always like to reiterate it again that it's always important to look out for general statements in the questions or in the stories. If you see anything that has to do with something that makes it general, that says everybody, or it can stop a particular thing and they use general statement, it's a signal that you should watch out for what is coming. And then you must always know the question that is being asked. When you see things like most likely, least likely, it tends to change what the answer would be. And I always like to repeat that this end of curriculum summaries are important, and that is important across all the subjects that you will do, whether it's ethics, whether it's quant, whether it's financial statement analysis. It's always good to always start from the end of curriculum summaries. You read it so that you know what you're expected to know in each of the reading and what is likely to be tested. And of course, practicing the questions, both the end of curriculum questions and the online question banks. I think they're very, very critical because that's how you test your understanding and that's how you're able to uh, remember whatever it is that you've read. So the more questions you practice, the better you are. And I think I'll drop these two links in the chat as well. It's just summary of the CFA code of ethics and standard of professional conduct as well. And then the second one is about the framework. I think I will drop those ones in the chat as well, but they're on the slide, which I believe will be shared also with you guys. So let's dive straight in. These ones, I know these are your bread and butter because you've already done this in level one, but I'll go through them quickly. So before we get into the thick of it, this is just to serve also as a revision exercise. So of course, ethics encompasses a set of moral principles and rule of conduct that provide guidance for our behavior. Ethics is from the Greek word ethos, and it means character. And they tend to use it to describe what is the guiding belief and ideals, that a group or a society actually share. So it's moral principles that guide our action, what we believe to be right, what we believe is expected of us in different societies. So what are moral principles or ethical principles? A lot of us know things when people say, oh, it's about character, honesty. Those are samples of what we call moral principles. And this is what is expected to guide what is acceptable or obligatory behavior. And of course, if they tell you what is right behavior, they invariably also tell you what is not right behavior. So most societies, whether it's CFA society or medical association and things like that, they have certain principles that guide members of that society. So that's why we have code of ethics. We say code of ethics serve as a general guide for how members of the community should act. And then these oftentimes are codified into specific rules that specify do's and don'ts. And that's what we then call standards. And standard of conduct, they serve as benchmark for the minimally acceptable behavior of community members. So the first thing to highlight here is that they are benchmark. Benchmark means something that you refer to, that is standard. And then they prescribe minimally acceptable. You need to know the word minimally. That is the minimum expectation. Of course, you can always go above and beyond those rules. So keyword is minimally acceptable behavior. And then it helps people clarify that code of ethics. It then breaks it down into do's and don'ts, which is what we will see in this course. Of course, when we talk about profession is an occupational community that has specific education, expert knowledge, and framework of practice and behavior, that governs trust, respect, and recognition in that community. And there's an obligation for professionals to go beyond their codes and standards. That's why we said it's minimally acceptable. So you wouldn't say, oh, because the code says this, I don't have to do above this if it is required. If it's required, the code is just a minimal expectation. For some of you, you might have written your ethics before the amendment, but I expect that a lot of you might have done in level 1 after they made the amendments or the revision to the code and standards in 2023. So I've decided that we'll start from those revisions before we go straight into the code of ethics and standards that we'll discuss today. So of course, it was revised in 2023, and then they revised it in 3 key areas. And in the way they did it, they actually included a new standard and they revised 2 existing standards. So we'll talk about that. So the first one, within standard 1, professionalism, they approved a new standard, and that standard requires members to act with and maintain the competence necessary to fulfill their professional responsibilities. So they actually reinforced the principle that is already in the code of ethics, which we will see when we get to the code of ethics. I hope you can still all hear me. I just want to be sure that you're following me. So the first addition, you can just show with a show of hands so I know that everything is still going as should. So like we said, the first one that they added is they just added a new one, which requires members and candidates to actually maintain, they should act with and maintain the competence necessary to fulfill their responsibilities. Then the second amendment is to standard 5, which is about investment analysis, recommendation, and actions. That actually revised it and said that the standard 5, the communication with clients and prospective clients, it now requires disclosures about the nature of services provided by members and candidates and the cost to the clients with those services. Of course, it specifies some things that should have been disclosed before, things around the limitations, but now he's specifying that it should actually disclose the nature of the services and the costs associated with the services. Then the third change is actually standard 6, which is conflict of interest. So it changed from what it used to be, because it was just conflicts of interest. It used to be just disclosed, but now it says that standard 6A says you should avoid or disclose conflicts. So in the previous one, there was no emphasis on avoidance. So this one is introducing it to say that you should avoid or you should disclose conflicts. So you either avoid conflicts of interest or you disclose those conflicts. So that's a change. So let's go straight into the summary still. So like we said, what is required now in the standard 1E is about competence standard, and it says members and candidates must act with and maintain the competence necessary to fulfill their responsibilities. So the second addition or amendment is disclosure of nature of services and cost to clients. So here is in standard 5, where you talk about investment analysis, recommendation, and actions. The B, it then says communication with clients and prospective clients. Here, the standard says that members and candidates must disclose to clients and prospective clients the nature of the services provided, along with information about the cost to the clients, costs associated with those services. So that's it. So the final one is actually as it relates to conflicts of interest, which now is amended to say avoid or disclose conflict. So this requires the members and candidates must avoid or make full and fair disclosure of all matters that could reasonably be expected to impair their independence, objectivity, and interfere with their respective duties to their clients, and interfere with responsibilities to their clients, prospective clients, and employers. So here is about avoiding and then making disclosure. And of course, it's always said that you should ensure that disclosures are prominent. They are delivered in plain language, no, dotted lines or hidden language. You must communicate it in plain language and then effectively to those that will be utilizing the services. So let's do some quizzes. I'll just ask some questions. I'll just take 2 from this. You can just drop the option A, B, or C in the chat when we talk about the first one. So we'll take the first one. So it says, which of the following statements is the most accurate? Ethics can be described as a commitment to upholding the law. B, an individual's personal opinion about right and wrong. C, a set of moral principles that provide guidance for our behaviors. So what are your thoughts on what the answers should be? Let's see your excellent. I can see the answers coming in. All right, sorry, I had to do that so I could see your answers. I think I need to make it slightly different. So I can see that. Okay, excellent. So excellent. So it's B, just like you said. So it's a set of moral principles that provide guidance for our behavior. I would just skip most of this one because you guys are level 2, so I know that you have a bit, a background in ethics. I think another thing I'd like to reiterate is the question 2, which says that which of the following statements is most accurate? Standard of standard of conduct are a necessary component of any code of ethics. That is incorrect because some societies are actually the ones that go ahead to codify you know, those code of ethics into what they can see as the minimally acceptable standards of conduct. So B, it says serve as a general guide regarding proper conduct by members of a group. That's not correct either. So C, where Grisham said it, it's actually benchmark for minimally acceptable behavior required of members of a group. And then, of course, when you're talking about specialized knowledge and skills, the ones that actually tend to share the code of ethics, they are profession. Just remember finance profession, or you remember medical, practitioners. So that's a profession. So that's it. So there's another key element that we will discuss briefly as we go deep into our conversation this afternoon. So that's when we talk about ethics and the law. What's the relationship between ethics and regulation? So I'll take the first paragraph. It says, laws and regulations often codify ethical actions that lead to better outcomes for society or specific group of stakeholders. Keyword, legal and ethical behavior, they tend to coincide, but they don't necessarily do that all the time. So we're saying that you can't have behaviors that are legal but are not ethical. An example is if you have an insider information and you trade on it. In some countries that are not as developed or have transparent rules in the financial markets, there are no direct law against people profiting from insider trading. However, ethically, it is wrong because it hurts the whole society at the end of the day. So that's an example of where something that is legal is not necessarily ethical. And sometimes you could have something that is ethical, but termed illegal. I mean, we've had things before now where people will protest, as to some injustice. And then maybe in the future test, you then have some of the laws change. For instance, things around maybe apartheid, slavery. At some point, in some places they were not necessarily defined as illegal. So legally, you could get away with it because it's not illegal. However, when you talk about morally right principles, it's a different ballgame. So legal and ethical behavior may coincide, often coincide, but they do not necessarily always mean the same thing. So we then talk about ethical decision, making framework. That's one of the second links that is on that slide, which, they will share with everyone later. It summarizes it so that you have an idea. So here it's saying that when you go into a situation, especially as you work, sometimes things can, present, like a dilemma. And the best way you can approach is to make the best decision for the stakeholders involved is to actually use the framework, which the CFA Institute has put as ethical decision-making framework. And the elements are just four. First, it says you identify all the relevant facts, what's involved, relevant stakeholders, who would it affect, who do I owe the duty to, what duties do I owe, and what ethical principles are at play here, and what might be the conflict of interest. You need to identify that, as a starting, point. And of course, you need to consider things that can influence, when you're thinking your options and your actions. And that's why we're saying you consider situational influences, additional guidelines or alternative actions. And then, of course, you make a decision and you act. And a key element is that you actually review what it is that you are taking, the decision you've taken by reflecting, was the outcome what you expected? If not, why not? And then what are the lessons? So that when another ethical dilemma presents itself, you're better able to react to that. So I think I'll just go to this other question now. I think I'll take two of them before we go forward. So the first one says, when you're looking at ethical versus legal standards, which of the following statements is most accurate? A, all legal behavior is ethical. B, some ethical behavior may be illegal. C, legal standards represent the highest standard. So you can drop your, answers in the chat. Then we'll take the last question on this slide, which says, which of the following best identifies an internal trait that may lead to poor ethical decision making? A, overconfidence. B, loyalty to employer. C, promise of money or prestige. So let's look at the answers. Of course, we've reiterated that for the ethical versus legal standards, some ethical behavior may be illegal. That is the correct answer. And I can see that we have, some people actually answered that. I think I can see Alfred answering that as correctly. So the last question, like we asked, is actually overconfidence. So why do people tend to make mistakes when they find themselves in tight spots, especially when it comes to ethical dilemma? Sometimes people just assume that naturally they are honorable, and so they believe that in any situation they will do the right thing. That's the overconfidence. However, apart from the natural trait, which I highlighted in this last question, the internal trait that makes people make poor ethical decision making, that overconfidence that, oh, in any circumstance, I trust myself to do the right thing. When you're overconfident like that, it's easy for you to miss, some of the required action that you would take to present that. Yes, yes, yes. I'm just showing the answers. I hope you can see the answers. So I've gone to the second slide to show the answers. I'm just showing you that because, I want us to just get into the other aspects of what we're discussing today. I'm skipping this because I know you've done level 1, so you're at least familiar, and this is just like a revision. But another thing to point out here is on the third one, which is talking about typical things that challenge ethical conduct. And one of the major external factors is actually environmental and cultural elements, peer pressure, so to speak. Like some people isolated, they might act in an ethical manner, but if they see other people doing different things, they would then say that, oh, they don't want to be alone, and then they go with the crowd. So for external factors, something that is critical is actually external factors such as environment and cultural elements. So I'm going to skip this as well, just like we said. But let me highlight a question. Let's even take 2 questions from here. Because like I said, the best is to reiterate what you're learning and to learn it in a way that no matter how they ask the question, you can answer, is to do as many practice as possible. And that's why throughout the conversation today, I'm going to make sure that we're doing some of those quizzes. So let me take 2 on the slides and then we move ahead. So I would take question 1 and then question 5, because it tends to see questions like this in the curriculum and in some of the questions. So when you see the CFA reiterating some of those same principles over and over, it's something telling you that you should pay attention. So the first one says, to maintain trust, the investment management profession must be interdependent with A, regulators, B, employers, C, investment firms. So can I see your answers in the, I don't want to show the answer. Can I see your answers in the chat so we can see how people are doing, with that? Okay, sorry, let me just check. I'm not seeing answers. I'm only seeing answers from Alfred. Are we all not on the call? I'm waiting to see more answers to question 1 before I go to the answer. Any takers? Okay. So this one is important. I need to answer this one because the truth is that you've actually made a mistake here. Because when you talk about maintaining trust and interdependence, it's actually with the investment firms. Correct, Mary? The answer is actually C, because your regulators are meant to actually check what you're doing, review that. They're like how do I put it? They're like people that have oversight and design the regulation that is supposed to keep everyone at work. But when we talk about interdependence, it's actually between, the profession and the investment firms. So I think I'm glad we chose that question 1. So the answer is C. I want to look at question 5, so I can ask you guys to drop your answers in there. So it says, when an ethical dilemma occurs, An investment professional should most likely first raise the issue with A, mentor outside the firm, B, professional bodies outline, C, senior individual in the firm. All right, I can see the answers coming in, and that is correct. Your first line of action should always be someone within your firm. Maybe it's your supervisor, maybe it's your compliance officer. That is very important. So let's shift gears now and let's move straight into the components of the code of ethics. Okay, so let's start with that. So the code of ethics actually has 6 components, and that we will discuss shortly. So it says that members of CFA Institute, including CFA charter holders and candidates for CFA designation, that's yourselves, but I will shorten it by saying members and candidates must do the following 6 components. So we take them one after the other. So the first one says they must act with integrity, competence, diligence, and respect, and in an ethical manner with the public, clients, prospective clients, employers, employees, colleagues in investment profession, and other participants in the global market. Here he's just saying, no, we've defined ethics as morally right principles. So this is just saying you have to act with integrity, with competence, and you remember that they introduced a new standard, which is about competence. So you can see that integrity, competence, diligence, and ethical manner is important with all the people you deal with. And of course, in the course of your career, you're dealing with the general public, clients, prospective clients, employers, employees, colleagues, and other participants in the global capital markets. So the second one says you must place the integrity of the investment profession and the interests of clients above, their own personal interests. So here it's saying that if you were to rank, you will rank the investment profession first above yourself. You will rank the interest of the client because some clients might want something that is not necessarily in good tandem with, investment profession. So the investment profession ranks first, followed by interest of the client, before you then come to your own personal interest. So the third one says members and candidates must use reasonable care and exercise independent professional judgment when conducting investment analysis, making investment recommendations, taking investment actions, and engaging in other professional activities. So this is the core. It's saying that whatever you're doing, you must exercise care and independent professional judgment. Of course, we're still going to see the standards and how they codify these 6 components, but keyword here is just saying that you can't make a decision without, using care. You can't make a decision without ensuring that your judgment is not influenced by other people, that is influenced by your professional, you know, actions. Okay, you cannot just say, oh, because somebody told you that this stocks is good, you also say this stocks is good. On what basis? Have you exercised your independent judgment to actually check what it is that you're doing? So that's what that is about. And the fourth one says members and candidates must practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and the profession. The fifth component says members and candidates must promote the integrity and viability of the global capital market for the ultimate benefit of the society. Remember, they must promote the integrity and viability of the global capital market for the ultimate benefit of the society. And the final component is members and candidates must maintain and improve their professional competence and strive to maintain and improve the competence of other investment professionals. Very, very important. So that's it. But before we shift gears and go into the standard of conduct that codify those, I think I'd like us to revise, some of the elements of the Institute's professional conduct program. Of course, we know that all CFA Institute members and candidates like yourself that are taking the CFA exams, you are required to comply with the code and standards. And then, of course, the CFA Institute Board of Governors, they actually maintain oversight and responsibility for the PCP program, which is the Professional Conduct Program. And of course, they do this in conjunction with the DRC, which is the Disciplinary Review Committee who is responsible for enforcing the code and standard. So anytime they're asking you what is the role of board of governors, you already know that it's just like the board of any company at all. They are typically tasked with oversight and responsibility. Out of the, you just said with the oversight responsibility for, you know, the company that they are board of governors over. So once you see that, just know that it's oversight, and that responsibility. So that's very key. And of course, you know that when you're writing your exam, you would have filled in some things to confirm that, oh, you have not violated any recently, you have not been a subject of, would I say, investigation. That's you self-reporting. So sometimes people self-report, sometimes they see it's not full of media when someone behaves in a non-ethical manner, or maybe somebody actually whistleblows to the society. Those are the ways that they get to find out. And of course, the outcome can be varied. It can be that they do the investigation, they realize that it's not true, you didn't violate any rule, or maybe decide to give you a warning, or maybe the student decide you cannot take the exams again, or is a public censure, or is a revocation, of the CFA charter. That's important. But a key part of this is that, of course, when the DRC reviews a particular case, they would come up with, recommended, would I say, penalty or the action that will redress the case. The candidate can decide to accept or not. However, when the candidate does not accept it, then he can take his case, further. That's when he takes his case to this disciplinary review committee, where those ones that tasked actually determine whether there was a violation and what sanctions should be imposed. So I think this is critical to just talk through. I think we talked about this, but let's take this question 3. Okay, sorry, question 4. And let's just drop the answers in the chat. So it says, the current code of ethics principles reads in full: promote the integrity, A, and viability of the global capital markets. B, off and uphold the rules governing capital markets. C, and viability of the global capital market for the ultimate benefits of the society. So what's your answer to that? Excellent. C, I can see that none of you fell for the trap. So this is the part I think I should reiterate. Sometimes when you see an answer and the first part is correct, as you can see, the A part of this question is actually correct, but just correct up to a certain point. Because the question says the principle reads in full. But it can be tempted as you just say it and viability of the global capital markets, you just take the answer, you move on. Which is why if you finish early, I would suggest go through your questions again if you have time. Because sometimes you will see that you were so quick to answer, but you're actually not answering the question that is asked, even though you know the answer. So those are the things you need to watch out for. So here it says, it's C that is correct because it says in full. Of course, and viability of the global capital market is there, but the first one misses out for the ultimate benefit of the society. So I just want to use this part to say that when you get your questions, it's good to actually read. On this level, this is when you start doing all those would I say more like case study kind of the question format. So I think it's important to reiterate that, which is the difference between what you would have seen in level 1. My suggestion is that when you want to see it, typically it's good to read the question first. You just scan the question to have an idea of what they're asking, which standard they're talking about, and then you go to the answer to get to the case to pick your answer. And I always say when you pick your answer, to read it again, just so that you're sure that you're answering the right one. And note keywords. Thank you, James. Yeah, that's what I wanted to remember. Very important that you just scan the question first. When you scan the question, get a sense of what the question is asking. You know, uh, then you now look at your question properly and then know what the answer is. So if just reading the question on your own, you can tend to answer where the answer is going. Then you will not be confused when you see the options, because the options can be quite close, which is intended to trip up people that have not really prepared. But if you prepared, you will see that. So I just thought I should mention that. So we're going to skip that one, but we're going to I think we should take 2 on this slide and then get into the standards proper. So let me see the two that we will try. Okay, so let's try question 3. That's very important. And then let's try let's do 3 and 4. Okay. So the question 3 says standard 3C, suitability, requires member and candidate in advisory relationship with the client to A, place the client interest before their own. B, consider investment in the context of the client's total portfolio. C, not knowingly make misrepresentations related to recommendations. So that's a question. So I need to see your answers. Okay, let me read the next one. So you drop the answers and we can take the answers together. So question 1 to 4 says, standard 3, duties to clients. Duties to clients say that members and candidates must A, document client financial constraints after an initial investment action. B, maintain an equal balance of interest owed to their clients and employers. C, deal fairly and objectively with all clients when engaging in professional activities. Let's go to your answers and then we can review it. So, of course, correct. Like I say, a lot of you got that, most of you. So, this is actually about ensuring that when you're looking at investments, you don't look at it in isolation. A particular stock might not work for one person. You're looking at it as a standalone, but you must never really look at it as a standalone. It must be in the context of your client's total portfolio. That is correct. And you can see that they some of the options are correct when it comes to different other standards. They relate to some other standards, some of the options. But you need to know the question that is being asked. Of course, C is correct, but that's not the question. That's not the question. Of course, they must not only make a representation relating to recommendations. But that's not the question. The question is, suitability. And that is answered by D, which you have all answered correctly. And of course, I can see the next question, everyone's answered that correctly as well. You must deal fairly and objectively with all clients. So that's correct. So let's go straight into the standards. Of course, we'll first summarize what all the standards are about. Of course, there are several standards of professional conduct. We will go deeper into them. You're already familiar with them. As you're doing this second time, I'm sure that you're reinforcing your knowledge. So the first one is professionalism. Of course, we said it is a profession, so you should know you should start with professionalism. Professionalism is standard 1. Standard 2, integrity of capital markets. Standard 3, duties to clients. And that one immediately is followed by standard 4, duties to employers. And 5, investment analysis, recommendation, and actions. Standard 6, conflicts of interest. And the final standard, which pertains to yourself as well as much as the members of the institute's responsibilities as a CFA institute member or CFA candidates. So let's dive into professionalism. Here I'll quickly go through what each of the sub-standards speak to. Then on the next slide, we'll talk about typical recommendations and what you should look out for when you're reading. So the standard 1, which covers professionalism, is actually, it used to be 4 sub-standard, but like I said, a new standard was introduced, which is the competence, and that's why I've highlighted it there on the slide. So the first one, standard 1, is knowledge of the law. And it says members and candidates must understand and comply with all applicable laws. Of course, for you to comply with the law, you have to understand it. So that's why I say members and candidates must understand and comply with all applicable laws, rules, and regulations. That's the first element. The second element is that in the event of a conflict, they must comply with the more strict law. You will see the application in the next slide. So in the event of conflict, just remember, you must always comply with the more strict law. You must never go for the less strict law. That's the second element. The other one is that you must not knowingly participate or assist in any violation of the laws. And then the final one says that you must dissociate from any violation of such laws, rules, and regulations. We will see the examples when we talk about, because this element is very important, especially around how you determine what is the most strict law. We will see some examples on the next slide that we'll discuss in detail. But the second one is, of course, when you know knowledge of the law, you want to maintain your independence and objectivity. That means you don't want to be unduly influenced. So this one says you must use reasonable care and judgment to achieve and maintain independence and objectivity. Nobody should color your judgment. You must not offer, solicit, or accept any gift, benefit, or compensation or consideration that could reasonably be expected to compromise your own or any other person's independence and objectivity. So you want people to have objectivity for anything they're doing. Nobody trying to influence you with bribe, with any form of compensation. So standard 1C, that's misrepresentation. This is saying that members and candidates must not knowingly make any misrepresentation relating to investment analysis, recommendation actions, or other professional activities. They're saying don't lie, don't mislead people. Don't present something you know is not what it is. Don't say something is not risky because you just want to meet your target. Those are the kind of things that misrepresentation speaks to. And the misconduct, just know the easy way to remember misconduct is what they say. Oh, don't do what your parents will not be proud of or what will embarrass you or your family. Misconduct is about not engaging in any professional conduct that involves dishonesty, fraud, or deceit, or any act that reflects adversely on you or on your professional reputation or on that of the society. So misconduct covers things around things that you would do that would embarrass, anyone or make them feel ashamed. Dishonesty, fraud, lying and things like that. So the final one is the competence, which was just introduced. And here it's just reiterating that you must act and maintain the competence to fulfill your professional responsibilities, which is why, you're taking the CFA certification. It means you're improving your competence. So that's what it's about. So I will take this one because it's important. So the way to look at it is that when they give you something that talks about application of the codes and standards, and they're looking at applicable law, the first thing you look at in that question is which law applies. Because now we're in a global place. Your company could be in the US, you're operating in Nigeria, but maybe the law says, oh, even though you're from the US, you're operating in Nigeria, the rule that applies whatever you do is the rule that is in Nigeria. So that's what you need to know first, which is why this example is saying, for instance, let's look at the first one. It says the member resides in a not strict country, but does business in a low strict country. But it says that it's the law of the low strict or less strict country that applies. So here, what you're looking at is that you should always remember that. You remember we had said, let me quickly go there. When we're looking at this one, we said that you must always comply with the more strict law. That's what you should remember. Which means you will never go for the law that is less strict. Rather than go for any law that is less strict than the code and standard. Your code and standard is the minimum. We have said it, minimally acceptable standards of behavior. So your code is the base. Any question you have, you assume that your code and standard is the first answer. However, when they introduce a law that is more strict than the code and standard, then your answer would be that more strict law. If it's a less strict law, you really don't care about that because the minimally acceptable one is the code and standard. Wherever is less strict, the code and standard is the answer. However, if the law is stricter than the code and standard, then you will go for the stricter law. So that's what this is about. Let's look at number 2. And let's just quickly run through 2, 3, and 4, just so that we get a sense of it. So it says a member resides in NS country, but does business in the MS country, where MS is the most strict law. And it says that it's the MS country that applies. Of course, which one is higher? You are always comparing to the code and standard. So the more strict law is what you're going to go for because it's stricter than the code and standard. So the law of the more strict law is what you go for. In the next one, it says member reside in LS country. That means this one, anything goes. But he does a business where his NS, they don't even do anything in NS. Those don't even have laws at all. It doesn't, of course, the LS law is what they're saying here applies. Like we said, LS law, you will never take anything that is inferior to the code and standards. So your answer here will just strictly be code and standards. And the final one that we'll look at is, okay, the member resides in LS, but it does business in a more strict country. And here it says the more strict law applies. So you compare the more strict law with the code and standard. Which one is stricter? Of course, it's the more strict law. So you retain the more strict law. So in summary, it's always the code and standard that is the yardstick. If the law that applies where you're operating is less strict than the code and standard, you will never adopt the less strict law. You will adopt the code and standards. When it is more strict or stricter than the code and standard, then you go for the more strict law. So that's what that is about. I think we've already answered that first quiz in another aspect there. And I think I've given an example of the number 3, which talks about, okay, let's take the question 3. I'll say the answer and then we can go ahead to the next element. So it says, which of the following is the recommended procedure for compliance with the standard related to independence and objectivity? Members should encourage their firms to A, prohibit any employee participating in equity-related IPOs. B, remove a corporate client company from research universe and put it on a restricted list if the firm is unwilling to disseminate adverse opinion about the company. C, provide every client with the procedural policies for reporting especially unethical behavior, violation and regulations, or other activities that may harm the firm's reputation. So this part is where I say that you need to check general statement. You can see that the first option says prohibit any employee participation in equity-related IPOs. Once you already see any is already, something for you to say, let me look closely. Why is he making this general statement, So you kind of say all should not, because, that's why you're an investment professional. You also want to invest in stocks. So you already know when they're saying any, every, all, you watch the questions closely. So of course, you want to protect independence and objectivity. So B is the answer, just like they put in the chat. So here it's saying that if you are reviewing the company's operations or issuance, and the person is your customer, and you reviewed it, you know that you don't want to review the answer because maybe it's bad or whatever, then you remove it from your list. You restrict it, you don't talk about it. And then, just remember that independence and objective is all about how undue people can exercise undue influence on your judgment through gifts, whether solicited or unsolicited. So I want to look at this, I want us to discuss this typical recommended procedure. So when it comes to knowledge of the law, we have discussed that. You need to know the relationship between the code and standard and applicable law. When there are violations, you need to notify. We said the person to report to is a senior person within the organization, then to dissociate. So it also gives some recommendations to how to actually be able to keep this. So to firms, it recommends that the information about applicable laws should be readily available to your employees. You should show them and you should have and adopt a code and standard, so that people can know what is expected for them. And of course, you should establish procedure for reporting violations. So what good is it if you have the rules and people just violate it? So there should be a way they report it and then there should be actions about it. And of course, as members, when we are tasked with them, of course, we have to stay informed about new happenings in our society, in what we do, review procedures, and maintain current files. Now, when you talk about the second substandard, which is talking about independence and objectivity, this has to do with a lot of things. You can see things around travel funding. We'll see an example shortly. Issuer paid research. So it's not saying you should not, some company can say, okay, the way we pay some of the rating agencies to rate you. Of course, when you do that, you just have to declare it that, even though you're doing this thing, you are being paid to do this. So that people can, take that information and decide whether, you're just saying it because of the money you want to make. And then, of course, you check how you are compensated. Your compensation should be flat fee, not based on the outcome of what your research is. And of course, travel funding, people can take you on a lavish vacation, and of course, it's because they want to win or curry your favor. So those are the kind of things you watch out for there. And if you look at the curriculum, you see that they give specific example covering each of these elements that are, listed there. But the key thing I want you to take away here is the recommendations. You say you have to protect integrity of opinions, even as the firm. People that do research, they should not be appraised or judged by income they bring. When you want their research to be thorough, to not be biased, so you should protect their opinion. And of course, we've mentioned an example about creating a restricted list. which means if you don't want to have to share negative thing about a particular company, maybe because they're your customer, then remove it from the companies you cover so that you can protect that independence and objectivity. And this part is very important. You see a lot of examples in the curriculum around that. That you should restrict, the kind of gifts you accept. And, things that people maybe want to influence you. Maybe you're a pension fund provider and you're trying to win an account. Then, you want to take them on a trip. That's you trying to influence their thoughts unduly. So things around gifts, around travel, very, very common in some of those examples over there. And of course, when it comes to misrepresentation, they are talking things around plagiarism. You write somebody's report, you don't even acknowledge it, you know, things around work completed for an employer. When you do any research work or any work for an employer, it belongs to the employer. When you leave, it's not yours. If you're going to take it, you have to ask, requisite permission before you can take it. So those are the things. So now take it and go and say it somewhere without the knowledge. That's misrepresentation. And of course, recommendation is that you must always make factual presentation and maintain up-to-date web pages. Some websites, the information there, you go there now, maybe it's 10 years old. You can't keep web pages and information there is not correct. And then, of course, it says that you must verify outside information and you must attribute quotation and summaries. That's talking about ensuring that you reference appropriately. For D, 1D, that's talking about, conduct, how it reflects poorly on, personal experience. Here, typically you talk about things that are code of ethics and ensure also that you verify employee references. That's why if you join any organization, they will verify a reference from the previous organization. That's how you can cover things around misconduct. And of course, competence, that's where people actually require minimal certification for certain rules and also continuing education. So those are the recommended procedures around that. I'll read some of this. I think I want to read uh, maybe two or three before we proceed. So this one it says that this one talking to research independence. So it says Susan Dillon, an analyst in the corporate finance department of an investment services firm, is making a presentation to potential new business clients that includes the promise that our firm will provide full research coverage of the potential clients. So the commenter is saying, watch out. Of course, Dillion may agree to provide research coverage, but she must not commit her firm's research department to providing a favorable recommendation. The firm's recommendation, whether it's favorable, whether it's neutral, whether it's unfavorable, must be based on their independent and objective investigation analysis of the company, their own independent assessment. So you can do that, but you cannot guarantee and tell them that, oh, it's in favor. No, so that's important. Now, this one is also important. Gifts and entertainment from related party. So it says Edward Grant directs a large amount of his commission business to a New York-based brokerage house. In appreciation for all the business, the brokerage house gives Grant 2 tickets to the World Cup in South Africa. That's an expensive gift. 2 nights at a nearby resort. Several meals and transportation via limousine. That's like living lavish. And then Grant fails to disclose receiving this package to his supervisor. So comments, Grant has violated standard 1B because accepting this substantial gift may impede his independence and objectivity. So every member and candidate should endeavor to avoid, situation that might cause or be perceived to cause. Let's just say you can say, no, 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 I will not be tempted. I can collect the money and still give my honest opinion. A third party will not see it that way. So once it can be perceived that way, that you've lost independence and objectivity, that is critical. So let's go to the next one. Standard 2, that's integrity of capital markets. And we have two substandards here. It's one of the shorter ones. So I'm sure you like that. So the first one says standard 2A, material non-public information. So it says members and candidates who possess material non-public information that could affect the value of an investment must not act or cause others to act on that information. Sorry, one moment. Okay, so what is the material information? So when you say something is material, it means something you would like to know, something that would have impact on the price of that thing or how people might want to deal with. So things like earnings, mergers and acquisition, maybe the company is just going into a JV with a bigger company or is about to be acquired. That's the material information that someone will want to know. There was say information is non-public. It means that it is yet to be disseminated in the public space. It means maybe just a few people know. It's not yet public. And the key part that is an exception to this is the mosaic theory. And that just says that an analyst may use all material that is in public domain and any non-material, non-public information, which means any information that is in public domain. Let's say I come up with it, I know that, oh, they've already said it. I'm just giving an example. Company A has acquired company B, is already public, everybody has said it. But what he then knows, but that is not material, is that, oh, the way they treat their customer service, is really, really good. The way they treat customers is very, very decent. A lot of people are seeing them as better than their competition. And so because this their customer service is exceptional, you can say that they will be able to win market share on his own, say in the next 2, 3, years. And he decides to combine the information and then make a decision. That is a different ball game. So you see, mosaic theory just says that an analyst may use material public information and also non-material, non-public information. So where the information is not public, the only thing that you can use is non-material, information. And we have defined material information as any measures amongst others. The standard 2B is about the integrity of capital markets, which is talking about market manipulation. So it's saying candidates and members, they must not engage in practices that distort the prices or artificially inflate the trading volumes with the intent to mislead market participants. If you know, the key word here is the intention. If your intention is to mislead capital market participants, that is already market manipulation. And we typically have two types of manipulation, either information based, where you disseminate false information, or transaction based, where you keep doing something with the intention of making people think it's not so. So I'll give an example. Of course, first one is the information based manipulation. You're lying. Then you produce reports. Oh, they've made this profit. Oh, they've made this sales, so that people will think the company is doing well. People will then, value the company higher and the price is going higher. That's information based manipulation. But when it's transaction-based manipulation, it means that let's say maybe the stock is thinly traded, but you don't want to give it the appearance that it is liquid. So you then incorporate different companies. You buy the stock in one name, sell it in another name, buy it in a third name, sell it in another name, just to drive activity. That is, an intentional misleading of market participants through transactions that you're doing. So when we talk about the procedures to watch out for, we have talked about it. Now, what material information? We said it. Things around earnings, mergers and acquisition, changes in assets or asset quality. If you know that they've, come up with an innovative product, but it's not yet in the marketplace, maybe a patent, new discovery, change in management, or change in auditor notification, that is a material information. So that is what you should not trade on, except it's in public domain. And that's what we talked about. Of course, we've also explained mosaic theory. So recommendations around there is to always, if you are in possession of the private information, try to encourage public dissemination, which is why you see most companies, when something new is happening, they will give a press release so that people can, be kept abreast, and then that information is disseminated. And of course, things around having firewall elements. Let's say you're in the research team, or you're also in their deal making team. You have some firewall that prevents information from, sweeping between the two units that should be different. And of course, you should always maintain your records. That's what can show that, oh, this is how you thought about this analysis, this is how you decided, and this is how you came to this conclusion. So let's look at an example. This is from the curriculum, actually. This is about market manipulation. So it says the principal owner of a financial information service company entered an agreement with two microcap companies to promote the company's stock in exchange for stock and cash compensation. So that means once they promote them, he will be paid in stock and in cash. So it then starts, the principal owner then calls the fire to disseminate emails, they design several websites, to distribute a lot of online investment newsletters, which are recommended investments in the two companies. This publication purportedly independent analysis and recommendation, they contain inaccurate information, very speculative and promotional. Of course, they are just trying to increase awareness, in the public space and then drive up the price. You already know that that is a violation. So the intention is important to know that. I think we've talked about the mosaic one, but let me see if we got the distinction. So let's do this first one and let's see your answers in the chat. So it says the mosaic theory holds as an analyst, A, violates the code and standard if the analyst fails to have knowledge and comply. Oh, sorry, let me see. Yeah, and comply with applicable laws. That's one. B, can use material public information and non-material, non-public information in the analyst analysis. C, should use all available and relevant information in support of an investment recommendation. So, what are your thoughts? Let me see your answers. Let me see, 229. So is that where the answers are coming from? So that is it. Exactly. So we're saying you can use material public information. If it's material, it must be public. Do you understand? If you want to use non-public information, then it must not be material. So that is the key. So let's move to duties to clients, because I want us to finish to be able to look at some segments of the Serengeti case. So duties to clients. So here it says standards 3A, loyalty, prudence, and care. It says you have a duty of loyalty to their clients, and you must act with reasonable care and exercise prudent judgment. You must act for the benefit of your clients and place your client's interest above your employer or your own interest. So here it's talking about loyalty. And the key thing you need to watch out for is, who is your real client? Who do you actually owe that duty of loyalty to? Here, there's two things around. Let's say you have a pension fund as your client. The pension fund is not your client. Your real clients are the beneficiaries of the pension fund, who expects you to abide by the terms governing, that fund. So be fair dealing. This one, say you must deal fairly and objectively with clients when you are doing what it is that you do. Of course, which involves providing investment analysis, making recommendations and all that. You must always deal with your client fairly and objectively. So you should not disadvantage the client over another. That's what this panel is talking about. We will see some applications shortly. The next one is suitability. With suitability says you should make reasonable inquiry, into a client's investment experience, risk and return objectives and financial constraints prior to making an investment recommendation. And I should judge the suitability of the investment in the context of the client's total portfolio. We have talked about that context of total portfolio earlier. So here, the state should make a reasonable inquiry to the client's investment experience. Somebody cannot just walk up to you and say, hey, can you tell me, is it okay for me to buy these shares? And then you say, hey, just buy it. I mean, you don't even know what the person does. You have not made, inquiry into his own financial state. Does he understand this instrument? You have to do at least the first due diligence in understanding the client's own investment experience, his appreciation of risk and return, his objectives, his constraints, before you then make any recommendation. And of course, standard 3D, performance presentation. It says when communicating investment performance information, you should make reasonable efforts to ensure that it is fair, accurate, and complete. So the information they are presenting must be fair, accurate, and complete. And of course, it goes without saying you must preserve confidentiality. That is standard 3E. It says members and candidates must keep information about current, it doesn't matter whether it's former clients, prospective clients, confidential, unless the information concerns the legal activities or disclosure is required by law or the client permits that disclosure. Very important. So here, like we said, key things is you must actually determine the real client. Is the client that the duty of loyalty is owed? For instance, you can have investment managers that are managing a fund. The duty of loyalty is owed to the subscribers to that investment fund, not the managers, because their interests might not necessarily align. So the actual client is what you need to watch out for. And they are easily identifiable in some cases. Just like we said, we give an example of pensions and trustees, that is the beneficiaries, ultimate beneficiaries that you owe that duty to. Of course, we talked about, when you're developing a portfolio, that you must not always look at it as a standalone. It must always be judged in the context of the customer's total portfolio. Then things around soft commission policies. There's something they call soft brokerage or soft commission policies. Soft dollar. It just means that that is meant for the account of the customer. So this one typically happens for people that actually have broker executed transactions. So they're saying those services should be used in things that will benefit the customer directly. Things around, maybe you're using to purchase a research service, but never for personal gain. You can imagine using soft dollar now to say you want to use it to pay for your CFA exam. How is that related to the customer? So it's saying that it is the asset, brokerage commission is an asset of the client, and it must be used to benefit the client, not the manager. So we said this, that once you look at this to the customer, of course, you look at this to employers, and one is loyalty. So it says you must act for the benefits of your employer. You should not deprive your employer of the advantage of your skills and abilities. And of course, you don't divulge confidential information or otherwise cause any harm to your employer. Standard 4B, that's additional compensation. So it says you must not accept gifts or benefit compensation or consideration that compete with or might reasonably be expected to create conflict of interest with your employer's interests, unless you have written, keyword, written consent from all parties. So when it comes to getting a compensation, from someone, no, that must be written, because it can be in competition with what it is that you're doing with your employer. So then you must not accept any gift benefit that might, create a conflict of interest between your employer and what you do. And of course, the C one is about responsibility of supervisors. So it says you must make reasonable efforts to ensure that anyone that's subject to your supervision or authority also complies with applicable law and rules and regulation and code and standard, because you are responsible when you are in a supervisory role. When you feel that the system is not in a way that can enable you to discharge that duty, you may have to decline that responsibility. So when you look at this one, it's saying it that, of course, the employer should provide working environment, ethical place. And when it comes to ethics and the code and standard, we believe that senior management, they have additional responsibility to actually model ethical behavior. That goes a long way in ensuring that the culture is that of an ethical organization. And of course, they just to make sure that the compensation is arranged not in a way that somebody can be, induced to do unethical behavior. So, of course, things around living an employer, we said that whatever you do to that employer, any work you do there belongs to that employer. Even the client leave belongs to the employer. If you want to go, you may then have to ask for permission. And of course, if there are things around non-compete that you sign, then you know that you have to abide by those. So it's very, very important. Of course, it's not saying that on your own time you cannot make arrangements or plans to leave an employer. Maybe on your own time, your public time, you're investigating on what you might do after. You can't do all that. It's just that you cannot take what belongs to the employer and do that. Of course, if you go into the public space, guess what? Some of the other things you can find the companies in public domain. And sometimes some of the knowledge that you gain while you're working in anything you is not changing. It's changed how you view things, how you evaluate things. So those are the things around duties to employers. So I left some of this there. Of course, they'll share it with you. And some of them, actually, most of them, I carved them from the curriculum. Just to reiterate that you always need to practice. I think I'll read this first one so that we can, look at it. Let me see the one I want to read. Okay, so this one, it says, Which of the following statements is correct under the code and standards? A. CFA institute members and candidates are prohibited from undertaking independent practice in competition with their employer. B. Written consent from the employer is necessary to permit independent practice that could result in compensation or other benefits in competition with the members or candidate employer. C. Members and candidates are prohibited from making arrangements or operations to go into competitive business before terminating their relationship with their employer. No. Just like we said, the key thing is that if you want to do that, you have to have written consent. Keyword, written consent. This is a bit different to another situation that you might see in the curriculum where, let's say, maybe you have a customer, is happy with you, and then it now gives you a separate gift outside of the compensation. Maybe say happy with how you manage his investments and it gives you maybe a ticket to somewhere. So that one is saying that you should notify your employee, after the fact. That's different. This one is saying if you want to do this, it has to be a written consent. So I'll read this short BN and we answer this and then we go ahead. So it says Lisa Hajak, CFA specialized in research on real estate companies at Cornerstone County Bank for the past 20 years. Hajak recently started her own investment research firm, Hajak Investment Advisory. One of our former clients at Cornerstone asked Hajak to update a research report she wrote on a real estate company when she was at Cornerstone. Hajak updates the report, which she had copied to her personal computer without the bank's knowledge, and replaces references to the bank with her new firm, Ajak Investment Advisory. So Ajak also incorporates the conclusions of the real estate study conducted by Realtors Association that appeared in the Wall Street Journal. She references the journal as a source in her report. She provides the revised report free of charge along with the cover letter for the bank's clients to become a client of our firm. Concerning the reissued research report, Ajak, now see the keyword, least likely violated the CFA standard of professional conduct because you can see the keyword is least likely. So this is technically saying, where did she not violate the standard? Because you can see that we already see the ones that she violated, like copying research reports without her employer's knowledge, changing it, replacing it. You already know she violated the report. But the question here is not asking if she violated the report, it's asking the one that she least likely violated, which is A. Solicited the bank's clients. They said it was the client that called her for it. She didn't solicit. So you can see that that is where the question becomes different. But of course, if the question was to have asked, did she violate it? Of course, she violated because she did not obtain consent, first of all, to get the report, which she collected, and then change the dates. But about not citing, she actually did cite the report because they said it appeared in Wall Street Journal, but she referenced the journal as a source in her report. So she did the referencing. So always remember to check the real question that is being asked so that you're asking or answering, the right question. So let's go ahead. Let me see if we should take one of the. Okay, let me take the first question. Just to use the first question since it's related to what we just discussed. So it says that Jorgen is a portfolio manager. One of our firm's clients has told Jorgen that he will compensate her beyond the compensation provided by our firm on the basis of the capital acquisition of his portfolio each year. So what should Jorgen do? So it's saying A, turn down the additional compensation because it will result in conflict of interest with other clients. No, that's not what the standard is referring to. Two, turn down the additional compensation because it will create undue pressure on her to achieve strong short-term performance. No, it says obtain permission from our employer prior to accepting the compensation arrangement. So she was saying, let her get that confirmation that she can get it. So additional compensation arrangements, when they're offered additional compensation arrangements from a third party, no, sorry, this is the next question. So I say you can obtain, permission from your employer prior to accepting, that's compensation arrangement. So the reverse, see this one. This one says, if it's that he's trying to do something else now. Oh, sorry, I think the question I repeated it today. What I wanted to reference is if, let's say now you now want to go to another employer after the fact. That one, you have to have written consent. You must have that written consent. So very, very, very important. So let's see this one. This is Melinda Jacobs, CFA, is a portfolio manager with SFM. Jacob teaches an investment course at the business school on weekend for a fee. He's planning to leave SFM and has begun developing materials for a new business that will compete with SFM. Has he most likely violated the standard? No. At this stage, he's still preparing. He's doing it in his own time. He's preparing the marketing paper. He's not, in direct competition with the boss. Okay. So let's go to the next standard, which is standard. Oh, so which is standard 5, which is about investment analysis recommendation and action. So the first one is diligence and reasonable basis. This one goes without saying. Anything you are doing, you must exercise diligence, independence, and thoroughness in every aspect of your, responsibility as an investment professional. Then they say, of course, you must have reasonable and adequate basis supported by appropriate research for any recommendation you make. You can't just say, oh, I believe this stock would do well. Why? What is the basis? Where is the research? What is supporting that line of thought? And then is it independent because you heard somewhere, somebody said it? No. So you must exercise diligence, independence, and thoroughness. Then second one, which also has an increase, something that is increased, apologies, that is increased, that they recently introduced, which is the one I highlighted in purple. Communication with clients and prospective clients. The other ones were there, but this one was just added. It says you must disclose to clients and prospective clients the nature of services provided, along with information about the costs to the client that is associated with service. So you must let them know the type of services you are offering, and then the nature and the cost. Of course, the other ones goes on to talk about disclosing the basic format and general principle of your investment process. They must know that you must probably disclose anything that materially affect those processes. You must disclose to them the limitation and risk with your investment process. And then this one, the last one is very key. You must distinguish between fact and opinion. You can say it's a fact, you can say it's your opinion, but your opinion, you must, categorize it as such. You cannot say your opinion as if it's a fact. So you must make that distinction. And then record keeping. Of course, you must develop and maintain appropriate records to support your analysis and recommendations. You must always have that. So let's look at this question. So it says, Wheeler is the research analyst. Sorry, let me just check time so that I'm sure that I'm on track and not running. Okay, I think we're good. So it says Wheeler is the research analyst responsible for following company X. All the information he has accumulated and documented suggested the outlook for the company product is poor. So the stock could be rated weak, old. During launch, however, Wheeler overhears a financial analyst from another firm whom he respects offer opinion that conflicts with Wheeler's forecast and expectation. He heard someone say something different. And upon returning to his office, he releases a strong buy recommendation to the public. How? How can he do that? So he's already violated the rules. So this one says, hey, violated the standard by failing to distribute really facts and opinion. No, this is not it. He had his own ranking as weak. But because he had other financial analysts say, oh, he's strong, he then changes it. So he violated the standard because he did not have a reasonable and adequate basis for his recommendation. So that's why that happened. And then, they say where there are no laws around how long you should keep your records. CFA Society, suggests that you keep the record for a minimum of 7 years. So take this example. It says, but that it says that's where there are no rules. That's why it's recommended. But where there are rules, follow the rules that is there. So that's what this example is reiterating. The last example says that, there are no applicable races to record restriction, but the firm says they should keep it for 5 years. So, stick with what the firm is saying. Now, let's look at standard 6, conflicts of interest. This was also amended So prior to now, they will just say, conflict of interest. But now it's not avoid or disclose. Before it should just say should disclose any conflict. But here is emphasizing avoidance as well as making full disclosure. They say you should avoid and make full and fair disclosure of anything that could be reasonably expected to impair, you know, your judgment. So that's that. Then when it comes to priority of transaction, it's saying that, investment transaction for clients and employers must have priority over investment transactions for, candidates and members where they're the beneficial owner. And referral fees. If you get any referral fees or fees for referring the service or referring the client, you must disclose to your employer, to your client, any referral fee, any compensation or consideration that is received or that you pay to others for recommending any product or service. So that's what that is about. And the final one, which is responsibility as a CFA Institute member and the CFA candidate. The first one is conduct of participants in the CFA Institute program. It says you must not engage in any conduct that will compromise the reputation or integrity of the institute or of the designation or the integrity and validity and security of the program. As a candidate, you should not cheat. When you are writing exam, they say pens up, pens up. Okay? And then the final standard is reference to the CFA Institute and the CFA designation and CFA program. Then when you're referring to the institute, to the membership, to the designation of candidacy, you must not misrepresent or exaggerate the meaning or implication of that. I've given some highlights here. So you cannot say that, oh, because I have CFA chapter now, it means I'm better than everybody and my results will be better than everyone. No, 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 no. That's an invalid way to reference that. Of course, you can say that you have passed all the exam. The exam is tough, is challenging, so those are the kind of things you can say. But you cannot say, oh, because I have that, then I've done it. And you cannot say, oh, I have CFA level 1 as they have passed CFA level 1 now. You can't say that CFA level 1 or CFA level 2. No. You can only say, oh, you passed your CFA level 1 exams. If you are registered to write level 2, or you've written level 2, you're waiting for your results, then you can say you're a CFA level 2 candidate. That's what you can say. If you have finished everything, you cannot say, oh, charter pending. No, you can say you passed all your CFA level exams, and you may be eligible for charter once you complete the required work experience. So for level 2, just like we said, the difference is that you have a lot of, linear style, you have a lot of linear style questions like case studies. And if you're not careful, you can now see so many information that can confuse you. But if you understand it, it's very good, which is why I recommend that the segment of the curriculum that talks about application of the codes, you take your time to review it. And like I would always suggest, make sure you have practiced and done all the questions way ahead of the exam time. But closer to the exam day, maybe 2 days to the exam, try and just go through the CFA code and standards again. That's CFA ethics curriculum, because that's how you refresh your mind and you answer some of the questions. And make sure you pay attention to the application. I extracted one of such cases, just for discussion, which is the Serengeti advisory services. So for the Serengeti advisory services, let's take some of the questions and let me, hear your feedback of the answer, and then we will be getting ready to round up. I hope you are all still following me. Type yes, and then we will go to Serengeti advisory services. Thank you, Mary James. Amina Nimi, thank you. So the Serengeti, and let me just read some of it and then we can take some of the questions. So the Serengeti Advisory Services is an equity research firm based in Texas. It was founded 5 years ago by 3 CFA charter holders, Bashar, Shah, and Kaifi. Forgive me if I'm murdering the name. So it says Serengeti analysts conduct investment research on listed African companies and serve the research institutional asset managers on an annual subscription basis. So their clients are predominantly asset managers based in North America and Europe. So each month, Subscribers receive 2 or 3 company and/or industry research reports. In her role as CEO and the head of research, Basha recently started a premium subscription service. For an additional fee, clients receive 6 additional reports of their choosing per year. Now, because of the cost of the premium service, Basha offers it only to clients that she believes can afford it. That's question 1. So, what are your thoughts? By offering it only to clients that she believes can afford it, has she violated the standard or not? Drop your thoughts in the chat. Let's see. And I'll go through the answer shortly. So for that question 1, yes, exactly, Orolu, as you said it, she's violated it. Now the standard, exactly. I like that you're even going ahead to say exactly why. Fair dealing. So why is that? So she can actually offer different services, premium service, which is different from standard service. However, she must offer that service, you know, to all the customers. Let the customer decide if they have enough money to subscribe to it. So this one is talking about, how you cannot do a selective, representation. So I want to show us there's a way that I coined that. So he's saying that, of course, she has violated that, but why? That's because even though you can differentiate your services to clients, but the different level of service must not disadvantage or negatively affect that client. What does that mean? It said it should be disclosed to the clients and prospective clients. It should be available to everyone. You should not offer it selectively. The way she selectively said that, oh, I think only these people can afford it, so I'm offering it to them. No, you should offer it to everyone. Let them now subscribe to it as they can. So you cannot selectively offer premium service to some customer. You can offer premium service, but it cannot be offered selectively. It should be open, and then they will know if they can afford it or not. So let's look at the second one. So it says Serengeti's research analysts provide investment recommendations for small to medium cap African companies. And one of the companies included in Serengeti's most recent list of recommendations is Beho Telecommunications. Unknown to the researchers, Beho was founded by Basha's father-in-law and is a majority owner by Basha's husband's family. So Serengeti Research does not include the mention of Basha's connection to Beho. So tell me, is this a good, thing? Is it inside, what people should actually be doing? No. So just like we said, you cannot have that. You must disclose it. So how do we know? Customers will want to know that, oh, is Bashar's grandfather, the father-in-law, that is behind this. So you're going to be publishing something about Weho Telecommunication. You have to disclose it and disclose your family's financial interest in it. And the disclosure should be prominent, not in tiny letter that people will never see at the bottom of it. It should be in plain language. You must say that, oh, disclosure. This person, has a stake in it is related to me. So let's look at these 3 procedures. It says some of the procedures that is implemented to ensure fair, proper use of third-party research includes the following. Procedure 1. When a research report, hours or DS cite specific quotations as attributable to leading analysts and leading experts, I require the analyst who wrote the report to name the specific references. Does that one sound okay? Of course, if you are going to quote someone, cite them as references. We know that even from our academic exercises. Procedure 2. When a research report contains statistical estimates or forecasts prepared by others, such as economists, and identifies the source, I require the analyst who wrote the report to remove any qualifying statement of caveat that may have been used. Without saying anything, I know you know that is wrong already. When they put caveats, economists, they say ceteris paribus, all things being equal. You always have to put the caveats, that proceed with any of such research because it makes you see the full context. Procedure 3. When a research report contains charts and graphs prepared by others, I require the analyst who wrote the report to cite their source. Of course, still back to plagiarism and citing. So just like we said, the one that is important is you cannot tell them to remove qualifying statements. Okay? So I'm saying it because this particular examples are how you get familiar with answering questions in the linear style. And it's important that we practice it. Of course, I still have it there, but I won't go through everything because they're in the curriculum. I will just charge you to make sure that you actually practice those. And in conclusion, I'll just go over key things that we said. It's very important that you read the ethics curriculum. Read it because sometimes some of the questions are nuanced. One single statement can change the meaning or change the question entirely. By saying the least likely now, you change it. Or to say, oh, which standard didn't she violate? It means you are saying which standard did she comply with. So those little sort of things are important. And as you practice, you would get it. And I think if you look at it, like all this one around paying for expenses or trip. It's always better to, you can only accept modest one, not lavish one. And even if some modest one, they want to accept anything modest. If someone is looking for something, pay out of pocket from your own institution for your travel expenses and co. You will see that a lot. You can see this example. Let me take this last example as with close. So it says Bashar knows that they've invited him to a forum. Says, of course, if he attends the training, he will benefit from it and all that. So it says these are the possibilities. First, they allow that company to pay for all their expenses. You already know that. Why must they pay for all your expenses? So you allow them to pay for your air travel and hotel travel accommodation, but you pay for your meals and entertainment. That's not looking okay. It's a forum they invited you to. Mostly, when you go for a forum, you would have paid a registration fee. And typically to cover the forum material and maybe modest meal. So you can see, it's three. You allow others to pay for the forum's meals and entertainment, but you pay for your air travel and hotel accommodation. Always, do that to maintain independence and objectivity. So every other one I leave in question, just a second one from curriculum, and you can always read them there. And remember things around, if you're escalating any breach, you start with the senior individual, at the firm. So I think that's it from me. We can take questions, and then I wish you the very best in your exams. I pray that God grants you grace and favor and that you excel. And then I pray for the grace for you to actually put in the work to revise and to do what it takes, like we say, a minimum of 300 hours and all the best in your exams. So that's it from me. If we have questions, I'm sure the society will send you the slides. And that's it from me. So thank you, everyone.
Thank you so much, Hadiola Badebo. Thank you for the great delivery of ethical and professional standards. That was 1 hour, 30 minutes, well invested. Thank you very, very much. On to the final class for May 2025 CFA Level 2, Day 2 Revision Bootcamp. We have Derivatives by Fola Bibola.
Thanks. Hi, everyone. I hope you've been having a very productive session with the other courses. I'm just going to go straight to questions because we only have an hour. And I believe that just like the previous moderator said, practice is very important. And every time I try to conduct like a 1 hour session explaining concepts or doing the summary, there's really never enough time to go through all the questions. So unfortunately for now, we'll just have to go through a few questions. I'm going to share a slide of questions that I have prepared. And hold on one sec. Sorry, one sec. Right. Please confirm that you can see my screen. If you can see my screen, just type yes. There's a comment, chat. Thank you. So we'll start with this question. And I'm sure you know now, level two's question format is different from level one. So level two is like they give you a long passage, and then from those passages, you have to answer the questions, which can be very challenging, in the sense that you have to, besides just looking at how to answer the questions, you also have to kind of figure out what the question is asking, where the question is coming from, what statements are being made, and all that, which can be tricky. So that's why practice is very important. Okay, so enough jibby jabber. Derek Honey has his own portfolio management business for years. Several of his clients have fixed income positions. So now we know that there will be some focus on fixed income. So the fixed income part of derivatives is what should come to your mind here. And one analyst has advised his firm that the firm could improve the performance of this portfolio through swaps. So swaps is another keyword. Honey has begun investigating the properties of swaps, blah, blah, blah. His first one before, Honey knows the most basic type of swap is plain vanilla swap, where one pays this and the other fixed rate. He feels that it will be a good place to begin and enter into a 2-year annual plain vanilla swap, where Honey pays LIBOR and receives the fixed rate from the other party. To get an idea regarding the swap rate he can expect on the 2-year swap, he collects this. So now we have the first, we've you need to master the ability of speed reading. So now you have the first part of the question set. Sorry, the passage that was given to you. Now, what we then do is we then go to the question, because obviously one question will come from this, one or two questions should come from this part of the passage. Now, which of the following would be the least appropriate position to replicate the exposure Honey will get from the 2-year plain vanilla swap that he plans to take? So, where's the 2-year plain vanilla swap? Into a 2-year, so this is this. Let me get my writing. Okay. So let's take this away. So this is a 2-year. So 2-year annual pay claim. So annual pay. So you have a pay swap and a receiver swap. Now the cash flow is always, so the definition of the swap is always dependent on the fixed rate. So this means that this person will be paying the fixed rate. That's what he said, where he pays LIBOR and receives the fixed rate. So now they've defined it for us here. Now what they are now saying is this. What they are now asking is, I need to go back to the So, which of the following would be the least appropriate position to replicate the exposure Honey will get from the 2-year plain vanilla swap position he plans to take? So the first one, okay, so the first thing we need to understand is, in a 2-year plain vanilla swap that he takes, where he's paying LIBOR, so he's paying the floating rate and he's receiving the fixed rate. What that means is this person, Honey, wants floating interest rates, or wants interest rates, or wants LIBOR to actually fall. So he wants LIBOR to fall. Okay. So now what do you want? So you want so what he's doing is he's receiving fixed, paying floating, right? So what this means is you are short interest rates because you want interest rates to fall. Now, what did they say? Which of the following is least appropriate? Least appropriate. Remember, reading the question is very important. We need to look for the one that is wrong. So, what did they say? They say long a series of interest rate puts and short a series of interest rate calls. Now, let's understand this. If you are long an interest rate put, a put is like an option to sell. When you are long a put, you want the price of the underlying to fall, right? Now, when you are long an interest rate put, it means that you want interest rates to fall. So in this case, he is short interest rates, which is correct here. Now, this first part is correct. I don't know about the other part. Short a series of interest rate calls. Now, remember, when you are long a call, you want the price of the underlying to go up, right? But when you are short a call, you want the price of the underlying to go down. So now we are short here. So that's the term we need to remember here. We are short. So in this case, this is also correct because the payment, when you replicate if the position that Honey is in, Honey wants interest rates to come down. So this statement is correct. Now, B, short a series of bond futures. Now, a lot of people tend to get confused here. Now, what is the underlying of a bond future? The underlying is the price of the bond, right? When we are short a series of bond futures, we want the price. We want the price of the bond. When we are short, we want the price of the bond to come down, right? That's being short. However, remember in our fixed income, we said when we are short a bond, when the price of the bond goes down, the interest on the bond goes up. So in this case, if we are short a series of bond futures, we want our interest rates to go up, which is not being short interest rates. So this is wrong. So this should be the correct answer because they are asking what is the least appropriate. Now, the last one, short a series of forward rate agreements. We all know what FRAs are. The underlying of FRAs are interest rates as well, meaning that we want interest rates to fall, so these two are correct, which in the context of this question are wrong. So now, because this is the least appropriate, this is the correct answer. Okay. Okay, I hope everyone is following. Someone is raising their hand. You can just type in your questions if you have a question, and I'll come back to the questions. Because of time, I have to keep looking at the questions here. So given the one and two, so maybe I should just quickly explain something here. You gain in the context of of the swap that this person is in. So what is the person? The person is in a swap where Honey, he pays LIBOR. So when you are making the payments, you want to make the lower payments and receive the higher payments, meaning that you are betting that the pay the part of the payment that you make. So in this part, Honey is paying LIBOR. You are betting that this interest rate goes down, the LIBOR part. Now, and that's why for the options, this B part, what is confusing is a lot of people confuse the bond futures, the price with the interest rates. But when you are short bond futures, since bond futures gain when floating rates increase, that is, the bond price falls, such a position would give honey exposure, an opposite exposure to the floating rate payer position in this kind of contract. Okay, so now let's go to the next question. I've spent almost 10 minutes on this question, which should not be. So the next question, given the 1 and 2 year rates, the 2-year swap fixed rate will be closest to. So now, I think that we are talking about this part. So we've been given the market data. In the curriculum, we would have had to calculate the discount factor for each of these. But now, you know what the discount factor is, where you just say, so for the 1 year, you just say 1 over 1 plus 0.05, and then you get this discount factor. So they've given us this, so we don't have to calculate the discount factor. Now, what they are asking is, given the 1 year and 2 year rates, the 2 year fixed rate swap rate would be closest to. Oh, people are already answering already. But yeah, let's slow down a bit so for people that are still catching up. Okay, so the 1 year and 2 year swap rate will be closest to. So we know this, that let me go back to the. So the market data we have the market data on the top term structure. Now we can call our discount factor, we can use something called Z, which is, I think it's Schweizer that uses it. So we say 1 minus Z2, so this is like the 2 year discount factor, all over. It's a formula that was proven by the curriculum. There's a literature out there on how they got to it, but usually this is the formula, Z1 plus Z2, where this is Z2 and this is Z1. And what do? We just plug in our numbers, which is 0 divided by 0.9158 divided by 0.9524 plus 0.9158. And this should give you 0.0451. Remember, because these are annual rates, this rate is already annualized. So this is going to give you don't have to annualize it anymore. So this will give you 4.51%, if I'm correct. Okay. So 4.51%, which is B. Next question. Which of the following is most likely to be a conclusion that Honey would reach if the payer swaption has the same exercise rate as the market swap fixed rate? Right. So let's look at this. Which swaption are they talking about? Sorry, just 1 second. I'm trying to get the. I'm trying to look for the start of where the swaption was mentioned. Okay. Rosen asks Honey to arrange for him a payer swaption that matures in 3 years' time. Blah, 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 on the set of it swaption. So Honey wants to make sure he asks Ronnie what to include. Honey said that the possible, use of covered call. Rosen one. Okay. Which of the following is most likely to be a conclusion that Honey would reach if the pair swaption has the same exercise rate as the market swap fixed rate? So we all know what a pair swaption is. A pair swaption is like an option to enter into a swap. So a pair swaption gives you more flexibility. So, instead of just going into the swap where you don't really know what the interest rates are going to look like. Because a swap is an obligation. A swaption removes that obligation and it just gives you a right, meaning that you can exercise the swaption whether you can exercise the swaption and decide not to go into the swap. So now what they are saying is that if the exercise rate of the swaption is equal to the fixed, so if when you are calculating the rate, if the exercise rate is equal to fixed rate, what is happening? They said this payer swaption will be out of the money, which is false. It will not be out of the money because if the exercise rate is equal to the at market forward rate or fixed rate, then the receiver, right, and payer swaptions will have the same value. So the receiver swaption will be equal to the payer swaption. So both the value, so it will be at the money, not out of the money. The value of the payer swaption would be the same value as the value of an otherwise receiver swaption. So that means that because the fixed rate is at the money, ended up being at the money, the value will be identical. The third option, the payer swaption will be worth more. No, so none will be worth more than each other. So B should be the answer here. Please, can you go over the short futures position again? Okay, so let me just quickly go over that, what I said about the short futures position. Now, when you are, like I said, when you are long futures, it depends on the underlying. The underlying can be the price or an interest rate, depending on the type of instrument we are talking about here. Now, in this case, what we are looking at, because it's a bond futures, a bond, you price it, you look at it the same way you look at anything like a stock. You look at the price the same way. So it's not like a forward rate agreement. It's not like an interest rate call where the underlying is the interest rate. For the bond, they are looking at the price, right? So when you are long bond futures, when you are long, not short here, when you are long, you want the price of the underlying to go up, right? This is for bonds. However, when the price goes up, the interest rates come down. Now, remember, we said Honey is short interest rate. So once interest, that's the only thing you have to keep. That's the thing you have to keep repeating in your mind. He wants interest rates to go down. When he says interest rates to go down, he wants the floating rate, that is LIBOR, to go down. Now, in this case, if they had said this person is long a series of bond futures, this would have been a true statement. So this would have been a true statement in this case. But because they said this person is short, now when you are short, when you are short bond futures, when you are short, you want the price of the bond to fall, right? When the price of the bond falls, the interest rates rise up. And so we are looking for a position that is similar to what the position honey is taking. Now, what they are saying is, which of the following is false? Now, in this case, this is false because if you are short a series of bond futures, you want interest rates to go up. But this person in particular wants the interest rates to fall. So that's why this is a false statement, and that's why B is the answer. Okay. Okay, the next question. For this question only, assume that the fixed swap rate is 4.5% and the notional principal is 1 million based on the blah blah blah. Okay. So now let's go back. So we've gone through all of this. We're now moving on. So we've gone through all of this. We're probably somewhere, I think we're probably somewhere here. So starting from here, we're going to suppose that after 1 year, so suppose that 1 year after the inception, the term structure is given as follows, right? I think we're looking at this whole data, right? You enter a swap based on this data, you calculate the fixed. So this is a LIBOR, you calculate the fixed rate. The fixed rate is what we calculated in the second question. And then we got 4.51. Now we enter into the swap. What they are now saying is 1 year later, 1 year after inception, the LIBOR term structure is given as, right? Now, for every LIBOR term structure, we have to calculate a new fixed rate if we want to enter into another swap. So clear all drawings. Now, this is the new term structure. This is the new term structure here. Now, what is the question asking us? The question is asking, based on the information, the value of the swap to honey is closest to. So 1 year has gone by. We have to now calculate the new value, the value of the swap based on the new term structure of rates, right? Now we've been given the discount factor. So the discount factor for a 1 year LIBOR is, so this is, we're using a 1 year LIBOR because 1 year has elapsed. Now the discount, so we're going to say the value to honey after 1 year would be 0.9535, right? Now, remember, let me see, let me just try and remind myself of something. Honey pays LIBOR. So honey pays LIBOR. So what does that mean? We have to calculate the cash inflow and the cash outflow. So honey pays 0.0488, right? So this is minus. Actually, let me. So you have minus, because you are paying this amount, 0.9535, right? Sorry, I made a mistake here. So this is a discount. This is a discount factor. We are discounting this amount, right? But let me start all over again, because so that I would give you the step-by-step breakdown. So you have this person pays 0.0488, right? Receives 0.045. Remember, this is the fixed rate. This is 0.045. This is the 4.5%, right? That that we calculated. So we calculated the, remember in number 2, we calculated the fixed rate to be this. Now, this is the fixed rate that Honey would be receiving because they have already entered into the contract. Okay? So now what do we have? Let's go back to this. Now, we then have, it's a 1-year contract. So we have to discount this amount, which is 0. The discount factor for 1 year is 0.9535, right? Now, we then have to use the 360, sorry, we have to, not the 32, it's a 1-year contract, so we don't have to discount. So instead of, it will be 360 over 360. Sorry, 1 year has elapsed, so we don't need to discount it because it's 360 over 360. Now, what is the notional value? We have to also get the notional value. So they said the notional principal is 1 million. So that's times $1 million. $1 million, right? So basically, that's how we then calculate the value of the swap. This is the amount that Honey is paying out. This is the amount that he's receiving. But because it's a 2-year contract, 0, 1, 2, we have to discount this amount. So this is the amount, this is the value of the contract as of here. We have to discount the amount back to this place. We apply this discount factor, right? So now this is a 360, this is a 1 year, this is a 1 year has elapsed, and it's an annual LIBOR. We then say 360 over 360, we then multiply by 1 million. If we do this, we should receive minus 3623, which is a loss to Honey. And we would have seen that it's a loss already because the amount that this person is paying is more than the amount that they are receiving. Okay. Let me go to the next question. Which of the following is the least appropriate motivation for a covered call strategy? So we need to first understand what a covered call is. A covered call involves you sell a call and sorry, you sell a call on a stock that you already own. So, or on an asset that you already own. So it's also long position in underlying. Sorry about my writing. So long position in underlying. So the strategy actually is just aimed to generate income on a stock that you own. Now, which of the following is the least appropriate? Least appropriate. So this is correct. This is a true statement because the reason why you would engage or initiate a covered call is because you want to generate income. So because they're asking for least appropriate, this is wrong in context of this question. B, target price realization. So if you have a long position and you sell a call at a strike price, so let's assume you sell a call at X. When you sell a call, you have an obligation to sell. Remember, when somebody that buys a call, right, is long, wants the price of the underlying to go up. Now, somebody that sells so someone has to sell the call to this person that bought the call. When you sell the call, when you sell the call and the price goes up, the price of the underlying goes up. Once it reaches the exercise price or the strike price, once it reaches the strike price, what happens is the person that buys this call would exercise the option at this strike price. Now, you are short a call, you would have to sell the underlying. You have to sell the stock. If it's a stock, for instance, you have to sell the stock to this person. So that's why it's called target price realization, because your upside is capped at X. So if you have a stock that, let's assume you have a stock of Nestle. Nestle is trading at 800, right? You then sell a call at a strike price of 1,000. Now, what happens if the price of the call, if the price of Nestle goes to 1,000? What happens? The person that bought this call would exercise the call at 1,000, which is the strike price, right? You would then sell at 1,000. So that's why it's called target price realization. Why? Because you already have a target price. Your target price becomes the exercise price here. So this is true, but in the context of this question, it's wrong. So lowering exit price contradicts the core purpose of a covered call strategy, in the sense that when you are going into a call, you are not lowering the exercise price or the exit price. You are setting a price at which you want to exit the stock. So this is correct. Now, the last question is, and I suggest, because you probably get one question on this, I suggest you go and, even if it's twice that, just familiarize yourself with relationships between the variables within an option. So delta, gamma, how they affect the price of the call, the relationship between the price of the call and the price of the underlying, and all that. So what they're saying is the gamma position of a covered call is most likely to be what? Now, we all said a covered call is you have your underlying plus your call. So let me, so remember we said a covered call involves long underlying, short call. Right. Now, a long position in a stock. So let's assume for a stock, the long position in a stock has zero gamma, right? Because gamma measures the rate of change of delta as in relation to the underlying asset price change. So when you are measuring the gamma of an underlying, you are measuring how the price change. So you're measuring how the price changes, the change from how the price moves, the price changes from one level to the other. Now, a long stock is delta one position, meaning that for every 1 unit of change in the stock, you are measuring it against itself. So you have 1 unit of change. The 1 unit of change is equal to a 1 unit of change at the end of the day. So it's a one delta. Now the gamma measures the change in the delta, which is zero, because you are measuring each growth rate. But for when you are short a call, but let's start with when you are long a call. When you are long a call, the sorry, one second. So let me just go back to the stock. Your stock position is constant. There is no change in the delta of a stock position. So your gamma is 0 for a stock. But for a call, is different, because for a call, when you are measuring gamma, you are measuring the rate of change of an options delta. So how does the options delta change for every change in the price? They vary. So when you are long a call, um, the change in gamma would be positive for long call. The gamma is positive. Sorry, so the gamma position is positive because you have a positive relationship, right? But when you are short a call, because you are short a call, the relationship will be negative, because as the price goes up, your rate of change in delta comes down, which is a negative relationship. So in this case, B should be the answer. Yeah. Okay. So what I'm just saying is this: a positive gamma for a call option, it kind of says that the options sensitivity to price changes, so which is the delta. So option sensitivity to price changes increases as the underlying asset price change. So that is when you are long a call option. Now you now have to flip it and look at the other side of it. When you are short a call option, if you are long and there's a positive relationship, when you are short, it should be a negative relationship. No, gamma is not isn't non-negative. And maybe you should check the curriculum again, because if gamma was non-negative, then you would have to deal with puts as well, which has negative relationships when you are looking at the long position of a put. I might be wrong. It's been a while I looked at the curriculum. Maybe if you can find it, just show me. You can just put it there, like just copy and paste where you find it. But I doubt that there's non-negative. I guess maybe you are talking about the assumptions of the Black-Scholes model, where it says that it follows a log normal distribution because the price has to be non-negative. The value of the price of a call has to be non-negative or something. Maybe that might be but anyway, let me just quickly go on because of time. Um, okay, we've got 20 minutes more, so I'm just going to be as quick as possible. This is like a long read. I can send this. I'm sure you guys have come across all these questions. Some of you have probably solved these questions because I just picked them off the internet. But anyway, I'm just gonna go through all these questions. Now, this involves a very long calculation using a binomial method. I have to start drawing the binomial tree. So what I'll do is I would go to other questions, and then when we are done with the other questions, if there's still time, we'll focus on number 43. 44, with respect to his assessment of replicating the option payoff, this person is least likely correct about this. So let's go back to the passage. Athena advisors offer this, blah, blah, blah. I am somewhat familiar with options models. However, I would like to learn about these methodologies. The binomial valuation model can be applied to the 2-year blah. So this is for the question one, that was the first question we looked at. Now, I guess the statement they're referring to is this statement. So of course, now I think this is a year later. Of course, with the index moving down in the last 12 months, the payoff with these options could have been replicated without using options. My understanding is that the payoff would have been the same as the call option if you had purchased 0.567. You know what? This question is linked to the first question, and it can confuse if I don't start with the first question first. So what I can do is let me move to the next question, and then if there's still time, we'll do the first two questions. So let me move to the third question. So does the put option with a strike price of 750 currently offer an arbitrage opportunity? So let's go for the put option. So I noted that 2-year put options with a strike price of 750 cost 38.48. Using the information in exhibit 1 and today's index value, the valuation model calculates the current price of the put as 80.50 and it is trading at 92 euros. So these are two prices. There's a mispricing here in the sense that the the market price of the put is higher than the implied price of the put, right? So the market price is higher than the indicative price. So what do we do? In this case, there is an arbitrage opportunity, right? How do we engage in the arbitrage opportunity? There are different ways. We sell the puts and then, we go through a long process. But you just remember that because the indicative price is lower than the market price, there is an arbitrage opportunity. I would have loved to go through how you would undertake this arbitrage opportunity, but because of time, right? So does the option with a strike price of 750 offer an arbitrage opportunity? And the short answer is yes. The short answer here is yes, because the market price is higher than the indicative price. Okay. Now let's go to the next one. Sorry. The next one is, let me see if there are any comments. Okay. Okay, I guess the person that was asking about gamma, I guess the issue is for a long, when you are long a call, maybe gamma will be non-negative, but because you are short the call, I'm looking at the position that the person is. You are in a position where you are directly opposite from the person that is long. So when you are short the call, maybe the gamma is always non-negative, but your position would be negative. Um, I apologize if I can't explain it well. It's been a long time, sorry. But anyway, let me just move on to the next questions. So they gave us some Black-Scholes model assumptions. Which of the assumptions is not correct? Okay. Does someone want to say something? Anyway, so there are three assumptions here. Trading is possible at every instance. I think this is an assumption. This is a right assumption. Volatility can be predicted with certainty. Yes, one of the assumptions is that volatility is known. The annualized returns of the underlying follow a normal distribution. So this is a false statement because it follows a log normal distribution, right? So okay, gamma of covered call is negative. Okay, anyway, so assumption 3 is false here because the returns don't follow a normal distribution. Instead, they follow a log normal distribution. Okay. So in describing how a call option price changes, so what statements are we looking at here? Call option price change. Okay. I think we're looking at this part. So Shiza then asks, how do you utilize the BSM model of comparative option variables, such as how the option value will change for a change in a particular parameter? For example, we can estimate how the rate of change of an option price speeds up or slows down for a given change in the price of the underlying. So remember, for gamma measures, and that's what we're talking about. Gamma can be confusing, but gamma measures the relationship between the price of the underlying against the change. So against the change in delta. So it's like a second degree. How does the delta change for every change in the price of the underlying? So, for example, we can estimate how the rate of change of an option price speeds up. So we're looking at the rate of change, the growth of the option price for a given change in the price of the underlying. So in this case, this person is referring to the gamma. So now let's go back to the options. So Mester is most likely referring to what? The gamma. So we've got C here. Now, next question is, which of the following would Mercer likely conclude from the implied volatility in Exhibit 2 if he excludes the effects of moneyness and time to expiration? Right, so just a second. Okay, out of the money options to hedge is more expensive than establishing a long position with out of the money. So let's go to the exhibit volatility data in exhibit 2. Right. So what they are saying is the first option, using out of the money options to hedge is more expensive than establishing a long position with out of the money options. Right. So when we are hedging here, hedging means you are limiting your risk. So we are referring to a put here. So as the strike price is going up, right? Look at it. As the strike price is going up, our volatility is going up because as we are seeing here, the implied volatility goes up. And we know that as implied volatility goes up, the price of the option also goes up. There's a write-up on the curriculum that shows the relationship between the strike price of the option and implied volatility, right? So because implied volatility goes up here, when you are buying a put, right? This is like the value of a put. When you are buying a put, right? The price of your put goes up in this case because your implied volatility is going up, your strike price is going up. So when you are hedging, you are using a put. So in this case, where's the option again? Using out of the money put is more expensive. So it is definitely expensive here than establishing a long position with out of money option. So if you are establishing a long position, meaning that you are buying a call, in this case, what happens? You are looking for a situation where the strike price is lower in this case, ST minus X. The strike price is lower, and as the strike price is lower, what happens? Your volatility starts to reduce. So implied volatility is higher. So as the price approaches, as our ST approaches X, so let's assume we have an ST here, and then we have X. So this is ST and this is X. As our ST approaches X, the volatility is approaching. So out of the money puts, right? OTM puts is similar to hedging. Out of the money call, right, is similar to taking long position, right, in an option. Okay, so as we are looking at the strike price for call, the strike price would be lower, right? So it means that it will be cheaper to actually use a call, take an out of the money call. Let me erase this. Okay, so using out of the money options to hedge is more expensive than establishing a long position with out of the money options, right? The second option is using out of the money options to establish a long position is more expensive than establishing a short position using out of the money options. This is false because when you are using out of the money options to establish a long position, you are initiating a call, and with a call, your strike price goes down, and then volatility goes down, and that becomes less expensive. Now, the third one, using out of money options to establish either a long or short position is more expensive than using at the money options, right? So A seems to be the answer here. And like I said, you have a situation where when you are using out of the money option to hedge, you are establishing a put position, right? And in the diagram that was given to us, you have a situation where hold on, your put position is your value of your put is X minus ST, with this being the strike price. Now, as your strike price is going up, your implied volatility would go up as well. Now, what does that mean? It means that as implied volatility goes up, the price of the put goes up. The price of the put goes up. And that becomes more expensive than engaging in the call. Okay, let me go back to the first question. Let me see if so. Using the binomial valuation method and data in Exhibit 1, the price Mesa paid for the option 1 year ago for the call with a strike price of 750 is what? Okay, you have, sorry, give me a second. So you have at time zero, you have the price of the call is 720, right? Now our U factor is, what's our U factor? 1.15. So this becomes 720 times 1.15. So it goes up by 720 times 1.15, right? Which is our up factor, which gives us, hold on, just be sure. $720 times 1. So this gives us 828, right? Now, in this case, the second one is, it goes down by 90%. Our D factor, so that's 720 times 0.9, right? So 720 times 0.9 gives us 648. So this is the first stage. So this is the year 1. Now, after year 1, because it's a 2-year binomial valuation, 828, so another up factor, 828 times 1.15 should give us, if I'm correct, 952.2. Oh, I am out of time, unfortunately. So I have to stop here. But like I said, you can always go and look at these questions and practice the questions. And look out for more questions. Try and practice as much as you can. I wish you all the best of luck. Have a good rest of the evening.
And thank you so much, Fola, for that. It was amazing. And thank you to our other facilitators for the revision bootcamp today. Like we mentioned earlier, we're going to send out the presentation files to you. We'll also create a bootcamp playlist on our YouTube channel, which you can always refer to should you have questions or just to run through them once again. We wish you the very best in your exams and hope to see you next time, but when you are applying, but next time writing a different level than you are now, level 3. Thank you so much, everyone.
We are professionals. We are impact-driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietyng.org for more details. CFA Society Nigeria, making finance a force